Okay, welcome to everyone. Another Mellow Monday, and this time we've picked a date where lockdown's easing. So we expect to lose probably 15 or 20% of you to the pub gardens, the hairdressers, the barbers. Even the shops are getting a few of you attending today, but we certainly know we've got a really good show ahead. So many will be joining during the show as well. And it's good to see we've already got nearly 200 of you at the very start, which is great. We have a number of Mellow Mondays coming up. We have one on the 26th and 27th. Yet again, so many results from companies at by the end of the month. We're going to have another of our results roadshow events on the 27th. And we've got a brand new event, the Energy Transition, which will be a show that we're going to host in the early part of May, on the 11th of May. And that's a new one for us. And we got some really good companies and some really good speakers. So we're going to run it just for you. Anyway, I have with me Karin, and I think Karin's going to tell us the latest bits of news around the investor world. You there, Karin?
Yes, hi.
Hope there you are.
Great. Good
Excellent.
afternoon. Good afternoon, and welcome back to another information-packed Mellow Monday. My name's Karin Schulte. I'm one of the directors at ShareSoc. ShareSoc, as many of you know, is the not-for-profit society dedicated to supporting individual investors. And a while ago, we held a joint session with Mello about our Woodford campaign, and ShareSoc has endorsed the claim by Lead Day. The Lead Day claim is gathering pace, and whilst a couple of additional firms have or are about to start claims, it is our understanding that they have yet to secure insurance and funding for their process. So if you go to the ShareSoc website, you can see a list and a table of all the active claims, comparing them and giving a lot of information. So it's really important, if you are affected by this, to review the course of action you can take. So please visit the ShareSoc website and the Woodford campaign forum on the site for lots of useful information. Later this evening on Mello Monday, Aquis Exchange will be presenting to you. And earlier this year, Aquis, in conjunction with ShareSoc members, undertook a survey. And this survey revealed that many individual investors do not feel they have good or equal access to growth stocks. And some of the key findings of the survey were that about 55% of individual investors felt they didn't have or were not sure if they had good access to growth companies. And over 80% of respondents felt that individual investors should be able to trade shares in any public company they choose, irrespective of the exchange it is on. And I know that Aquis will explain more about that later. And about 50% of respondents commented that they don't believe they have enough access to IPOs and fundraisers. And whilst this situation has improved a bit during 2020, individual investors presently only get access to a very small proportion of fundraisers on the market. And organizations like ShareSoc will keep working on your behalf to help change that. Lastly, whilst everyone is still waiting to hear from the FCA on their review into the Woodford saga, the FCA have recently come out and warned that younger investors, of which 2020 saw a much larger number than had previously come into the market, that these younger investors are taking on big financial risk without realizing it. And the findings reveal that there is a new, younger and more diverse group of consumers getting involved in higher risk investments, potentially prompted in part by the accessibility offered through new investment apps. So the gamification of investing is a concern. And the research found that for many investors, emotions and feelings, such as enjoying the thrill of investing, and social factors like the status that comes from a sense of ownership in the companies they invest in, were key reasons behind their investment decisions. But it also showed a lack of awareness in the risks of investing, with over 4 in 10 not viewing the fact that losing money was a risk. So they didn't actually, 4 in 10 don't consider that they could lose money when they have invested it. And this is a concern. Amongst different generational cohorts, there are different trends emerging, with Gen Zs, those aged under 25, actually often more cautious and conservative with their finances compared to many millennials. So it'll be interesting to watch these younger investors who are also often more active shareholders. And finally, a ShareSoc event to watch out for is how to vote at AGMs and how to make your vote count. This will be held in May. David Stredder will be on the panel, and we will send out more information about this event. So I'll hand back to David and hope you enjoy the very interesting evening ahead.
Thanks, Karen. Yes, it's very interesting. The younger ones are definitely getting into investing, although in many ways they're using trading apps, which is always going to be a little bit of a worry. But certainly I can say from my own family, not only have all of my children now started to take an interest, it seems their boyfriends and girlfriends are also interested. So I've gone from having maybe just one in the family really taking any note to literally the family and all their other halves taking interest. So we've got a younger audience in the offering, I should think. I think we will see a lot more younger people taking an interest in investing over the next few years.
Yeah. Great.
Thank you, Karen. And one thing I'd like to just cover before we move on to our first panel session. Later this evening, we are going to have a charity element to our show. I think many of you will have seen the bash panel that we had in one of the previous shows, and also the results session that we had at the last show. We homed in on 1 or 2 companies that we thought were the wrong price. Now, I think there are a number of investors who probably have done really well over the last year, and charities have just not been doing well. They've been suffering from not having the visitors to their shops, not having the visitors to their events that they raise money at. And I think investors are in a good position. So I thought, let's combine the two and help each other out. And tonight we will have a session at the very end where there'll be a pledge to charity by the investors who effectively give a presentation on behalf of a company they think is underpriced. We'll set a target, and all the audience can vote on which of the investors have put forward, in their opinion, the best case, and the target will be met. We'll pledge the money from Mello, because we always like to help a charity at each one of our shows. Mello will pledge £150 towards that charity, and some of you can follow suit, and you can join in, or you can, on our website, we're going to have a page available from tomorrow where you can effectively put your own pledge, say the charity you'd like to help, and set a target for a company you know well. Once you've set that target, when it hits, you have to donate your amount to charity. Let's see how much we can raise for charity. I think it'll be a really good thing to do. I think it might even go viral. You never know. There could be hundreds of charities benefit. Pick a small charity, you make a real difference when you pick a small one, but they all probably need help. So whichever your favorite one is. Great. Anyway, now I've probably hopefully explained that, and let's start our first panel session. Mark's going to host this one because he's a bit of an expert in this area, I think. You had that as part of your book that you wrote, I think, didn't you, Mark?
Yeah, that's right. I sort of, in my book, I share some ways that investors can overcome some of the common investing mistakes. And the panel today, we're going to hopefully go over some people's mistakes, and investors are going to share their experience of learning from those and becoming better investors because of that.
Excellent. All the panel with you now?
Yeah, all the panel are there. So yeah, I'm joined by three investors here that most of you know well, at least by name or by Twitter handle. So we've got Leo, James, and Reb, and they're brave enough to come on here and share some of their investing mistakes with you as well. The panel, they've got a variety of investment styles. Some of us are full-time, some of us are part-time, but all of us have had market-beating returns in the last few years. And I think one of the reasons that is, and the panel have performed well in their investments, is that they have been willing to admit their mistakes and learn from them. And they're also happy to come on here and share that with you too. We're going to start the session just sort of discussing some of our personal mistakes, but then we're going to open up the Q&A as usual at the end for people to share some questions for us. Leo, I think you're going to kick us off with a tale of woe from your past. If you wanna
yeah, absolutely. So this is from many years ago, and I'd like to say I was really young at the time, but I should have known better. It was really interesting what Karen was saying actually about the new generation of investors not being aware that, or not being in the forefront of their mind that they can lose money. And you certainly can, and I've got a great example here. So back in 2006, I started investing in a company called Spähmühl Deutsch, which was a German residential property company. And it seemed a no-brainer. German residential prices were a fraction of, and literally a fraction, half or a third of what they were in an equivalent city in the UK. German economy was obviously really strong, so no obvious reason for that. And there were structural changes going on in the market, which made you think that this would be something that would adjust over time. The properties actually, you could buy them in a block as a portfolio at a discount to the individual property values that they would fetch in the open market, for example, to the occupier who wanted to buy their own property. So completely the reverse that you would normally expect. So I started buying out, and what I really attracted me to, what I was really focused on was this, that they got some financing in place and they were 80% geared. And therefore that meant that if German property prices went up 20%, then you'd expect you can do that's about double, right? Yeah, 80%. I don't know, something like that. So there was a big upside there. There's also a good yield, and there was some people involved who seemed to know what they were doing. So I don't know if anybody followed this story. Shall I just describe what went horribly wrong?
What was the outcome, Leo? What was the outcome of this great investment?
The outcome was a zero. They went to zero, which was bad. But what was worse was that I bought all the way down to zero. I kept adding and adding and adding. And the reason I kept adding and adding and adding was because each time it went down, I thought, well, this is wonderful. I can get them at an even cheaper price. What I failed to do was think, well, why are they going down? Why are these people selling? What I didn't model in particular was the scenario of covenant breach and what that would mean for them and how they would remedy it. And I didn't look into the cost structure when I first bought it. So they were brought down by massively inflated costs through a related, there was a related company that was managing properties, and they were charging way over the odds and doing it a very bad job. And in retrospect, and the covenant breaches were such, they had swaps in place to fix the cost of the debt. So if they needed to, as the properties fell, the value of them fell nominally in the financial crisis because of everything else that was going on. They needed to post more. They needed to sell some of the properties, but each time they sold one, they had to make good the swaps. which were obviously a massive loss at that point because interest rates had collapsed from 5% to 0. So it was horrendous, really.
So it sounds like a sort of mixture of leverage plus poor or misunderstand the incentive structure.
Exactly.
That was in there as well, and also just some of the capital structure, misunderstanding what the capital structure was as well, or effectively what the capital structure would be.
But the biggest mistake really was for me to keep buying all the way down, and that was a significant loss for me, and hopefully taught me a lesson. It seems to have taught me a lesson anyway.
Great. And James, I think you had an example as well which actually went to 0 for you, didn't you?
Yes, my example is a little bit more recent, so that the pain is still there, and that's Globo, which is probably a company name familiar to some investors. But in retrospect, Globo's business had more red flags than a communist parade, and the accounts had more adjustments than a chiropractor's convention. But at the time, I felt its business was mobile communication solutions. If I remember, primarily for businesses. It appeared to be and had all the hallmarks of a fast-growing, reasonably cheap business that was being successful and expanding and growing. And I guess in the time I held it, which was relatively short period, there was quite a strong mix of critics and supporters. And I probably didn't give enough time to look at the critics. I looked at what their comments were, but it seemed to me as if those were always relatively well explained by the company. But probably the red flag I should have paid most attention to was when the company launched a high yield bond issue. And ostensibly, as the company explained it, this was although they had apparently net cash on the balance sheet, the high yield bond was to give them additional firepower to go after acquisitions. And I think a lot of people at that point were suspicious, saying, as a company, you seem to have more than adequate financial resources. Do you really need to have this additional money at a very high cost in addition? Shortly after that, though, it unraveled quite quickly. In fact, the 21st of October 2015, the company cancelled the high yield bond. They cited local conditions in Greece, where it was headquartered, albeit I think it was more a lack of investor appetite. On the 23rd of October, the shares were suspended as a critical dossier was published, which actually demonstrated and highlighted how the company had used related entities and subsidiaries to manufacture fictitious sales and profits. And then the 26th of October, which I think was the following Monday, they announced the CEO and CFO had effectively admitted that they'd falsified the accounts, and it all sort of crashed from there.
I think this is one of the only cases where the CEO admitted there was some form of misrepresentation, because often, they put up a blank face and say, oh, it was, market conditions or something. And I actually write about this in my book, because it's very hard to write about these things if you don't want to be sued. So the fact that they did admit some misrepresentation means it's actually quite a good example to write about. So what did you learn from this? What were your kind of big takeaways?
I think ever since then, when there is, I guess, debate about a company, or is it really all it appears to be, I'm extremely cautious now. And we've seen some examples since where dossiers have been presented, or there's been a lot of discussion about certain aspects of the company. And in many respects, I do find it best to sort of sell first and ask questions later, because inevitably, if there is discussion about whether a company is all it appears to be. The share price will take a hit anyway, even if things are subsequently confirmed to be okay. And also really to give more credence to those perhaps raising critical concerns. I probably lent more towards commentators who were saying that this looked okay, and that was probably a mistake in retrospect. I think the other thing is that this is maybe an example of why people do hold overseas companies listed on the UK market to a higher level of due diligence, because it's harder to understand what's going on, how they're doing, and whether it really is all that they're saying it is.
Yeah, my Spain or Deutsch were in. Actually, I'm not sure whether it was Isle of Man or Guernsey. So it's not like you could go to the AGM. You know, it was as it was collapsing. It was very difficult to go and look them in the eye and try and work out what was going on.
I think, it doesn't mean every foreign listed company has issues, but you should certainly add an extra layer of caution, I think, when looking into these things, because you can't go and see their stores, you can't kind of do primary research in the same way, can you?
That doesn't always save you, since I had Kate, Patisserie Valerie, and I did research it quite extensively. It still went to zero.
Yeah, I think I've got some sympathy for that one. I think there's it was quite hard to, a few people spotted it, but I think a lot more people spotted that one with hindsight than were shouting from the hills at the start. Yeah.
I'm still saying I got that one wrong.
And you had a more recent example, but one that wasn't quite as severe as a total loss, didn't you, Reb?
No, it was a nice change. So I was saved by a stop loss. I took a position in a litigation company called Manolete or Manolete, depending on your pronunciation. And I took it because it was a new IPO, which I think also raises some discussion points. But I took it because it was interesting, and I wondered if it might be uncorrelated to stock market gyrations, because it was looked upon as perhaps a new asset class.
That was my idea with property as well.
Yeah. So initially it did quite well, but it started to slide, and a stop loss took me out back in February 2020. I think about £3.65, and to see today it's now at £2.56. So while it may come right, it certainly saved me losing any more money by having a stop loss.
And what's gone wrong? Is it just the speculative nature of the stock, or what do you think the learning point is?
Yeah, I think people have learnt more about them. I think it raises the question of IPOs too. Why are they IPOing? Who's selling? Who's getting the money out when it comes in? Or are they actually raising new funds because they want to expand or have an acquisition they've got their eye on? I just think it's knowing a little bit more about IPOs than I knew about Manolete at the time.
Yeah. And anybody else got any thoughts on risk factors of IPOs? Anything that you look for in an IPO wouldn't look for?
I think you need to look at whether the last year accounts is somehow out of line with what happened the 2 years before. And some people, I think, say that they've been prepared for sale, and I wouldn't say that. I would say it's more that they have a good year, and that's the point at which they go public.
James, any thoughts?
No, I think I'd echo the comment Leo's just made around the timing is usually picked by the sellers, and they will probably have thought about that quite carefully. So I tend to wait until there's a little bit of track record on list of the company being listed first, at least at the moment.
Shall I bring in my other famous example? Which is it's falling in love with a brand. So I have a love of Aston Martins, as some people might know, and I have one, and I do love it, and that's the reason that I shouldn't have bought some shares in the IPO. You can love a brand, but you don't have to follow it into the stock market.
Yeah, I think so. Sorry,
I was going to say, likewise, had I bought a German flat at the time, I would have doubled my money over a few years, because it, you know, the thing was good. It was the company that was bad.
Mm. Yeah, and I think that that's probably one of the hardest things is that, you know, if you love a product, it's very hard not to automatically assume. I think they call it the halo effect, where, you know, you know one thing is good and you automatically apply, you know, you assume that every aspect of that thing is good as well. And in this case, I'm not sure the kind of finances were necessarily aligned to the quality of the cars.
I should add, they'd gone bust twice before. You know, if it wasn't my Twitter name, if I was Skoda girl, it would have been all right.
I think for me, the other thing I like to look at IPOs is the kind of like incentive structure. So if it's a management team that are keeping their shares and they're raising money to expand the business, I look on that much more favorably than a private equity firm that's, you know, perhaps looking to pass the buck on to somebody else at the top of the market. So I think that's I mean, it doesn't guarantee that they don't have a slip up or problems, but that's certainly, I like to look at the incentives behind these things as well.
Yeah, that incentive structure was key with Spaymil. And I've got a company that's currently listed at the moment that has got about 10 points in common with them. Actually, if you're interested, I don't know how we are for time.
Interested? You think there's going to be a future mistake, or?
Well, I mean, I don't own it, so it won't be my future mistake. But I think that it's just the parallels are quite close. So it's Hypnosis. So that one was in domiciled in Isle of Man and the other in Guernsey. They're both backed by well-known and generally respected in industry figures. So there was Jim Mellon on Spaymil, and Murria, however you pronounce his name. There was an investment management agreement made for managing the assets. So Spaymil PLC managed that property. The Family Music Limited managed the songs. Who provide services through an investment provider, who subcontracted the actual management to somebody else. In this case, it's in the case of Hypnosis, it's the local performance rights organisations who actually collect the money and, you know, actually go and do it. They raised money to make a series of investments over several months, which of course they did, because the bigger the funds under assets, the more they got paid. They had a high nominal yield when they launched. They were debt funded, so Hypnosis was not supposed to be debt funded, and it's now taking on debt. They listed some C shares to make more acquisitions and then merged them in later. And they both wanted to move on to the main market.
Yeah, let's hope that one. The parallels are not what they seem, and Hypnosis are better.
It's the incentives. You need to look at the incentives. Yeah, because the incentive is to get as big as possible and borrow as much money as possible, not necessarily to act in the best interests of the shareholders. Yeah,
incentives certainly matter. So we've covered, before David kicks us off, I can't see any Q&A, so we're going to carry on. So we've talked about sort of what these are, you know, sort of errors of commission here. These are sort of things we bought into and have done badly. But I think you can also have errors of omission. So where you've you should have acted and you didn't. So have you got any examples of maybe some of these? Reb,
yeah, it's a classic mistake that I keep making again because I don't have enough conviction. So probably the one that kicks me at the moment, and there's been quite a few, but the current one would be best of the best. So by the time I'd worked out that it was a good company and I should have some, I didn't buy enough, and I've had to pay more as the price has gone up to increase my holding. I still think it's great, and I will buy some more again. But if I'd just been a bit more, had higher conviction at the start, I wouldn't have to pay £30 for them.
Yeah.
And
I
sometimes you can't get more shares, can you? Sometimes
No,
the
that is
market's
actually a
very thin.
liquid, or it was a liquid until the secondary placing.
Yeah.
Hopefully it'll be a bit more liquid.
So I've got a similar one, which is FinCap, and they just kept drifting down. There was a massive seller, and there was a really good opportunity there. You could read all the RNS statements and see they were going to have an excellent period. And I was just trying to like save another penny or something and wait for the price to fall a bit more before I went in and really bought in a big way. And when I realized that wasn't going to happen, I did add the shares at a higher price, but there just wasn't any shares there at that point. I was pushing the price up with every trade. So I was about half the size I wanted to be when they announced their trading update, which was a bit unfortunate considering how good the trading update was.
I think that's a common value investor error. I fall for that a lot of just being a little bit too cheap, not willing to pay up for something that actually is genuinely, or in my opinion, significantly undervalued, and then falling for the anchoring bias where I then won't buy on the way up. So I think that's still a work in progress for me on that, position sizing and being willing to pay up for quality or for things that you genuinely know should be a good investment. James, anything on that?
Some of the time we may take small positions initially, as where we've done initial research but we want to find out more about a stock, and then because we want to grow it to a larger position, but then the price sort of gets away. And that's where I guess there's the challenge of, okay, do I add more now, the price anchoring concern versus, well, it's not really the size of position that I'd wanted to get it to. And that's quite a challenge to sort of navigate those different conflicts, really.
One thing I try and do is hide my profit and loss. So I have a spreadsheet where I track my daily movements, and I don't put monetary values and I don't put what the actual P&L on any individual position is, because I find that that just makes that problem worse for me. I anchor on the what was my average buy price and things like that, and in reality it shouldn't matter, should it? So that's my tip for trying to overcome that. Right, still no sign of David. So I did have a couple of questions come in. So somebody was asking about kind of stop losses. I think this is your area, Reb. How do you manage, stop losses? What percentage do you use? Do you buy back into things, or is it gone forever? What's your thoughts?
I mean, I suffer from seller's remorse. So I have been known to buy things back. I'm not too proud to admit I've got it wrong. So I recently bought back Gamesy because it didn't sell it on the stop loss. I sold it because it was, I read the results and they were saying the first quarter ahead was in line. And I thought that's not good enough. And I'll put the money somewhere else, and then realized that I was actually wrong, bought it back, and I was lucky enough to catch a bid the following week. Although I think it probably should stay unlisted, but it probably won't. So yeah, stop losses for me, I generally set them and they're trailing. So hopefully as the shares go up, so does the stop loss. And I usually will set them quite around 20%, but it depends on how much the share move, because obviously some move a lot more than others. You don't want to get taken out as soon as you've started. But they do work for me, but I know it's a controversial subject.
Yeah, I think this is another one I tackle in my book of, I think they work for some people and they don't work for other people. And, the sort of key is to find a strategy that works for you, because we're all loss averse. We'll all struggle with particularly losing positions, and a stop loss is a very good way of dealing with that. But also averaging down is, the key is to kind of find what fits with your psyche and find your way. And it sounds like you've found a successful way, and you stick to your guns, which is
sometimes
the important thing.
Mark, did I hear you say way there? So way education, I spent a year averaging down all the way to the bottom, and then it didn't look back. And as you guys probably know, it's got a takeover bid, an agreed cash takeover at the moment, about twice what I started buying at, I think. But I bought lower than that on the way down. So sometimes averaging down works. But I think you've got to understand why the price is falling, because there's always a reason. And if you don't know what it is, then that's where the problem is, I think.
And I think that a Australian hedge fund manager called John Hempton's got a really kind of good blog on this, and I kind of refer to that in my book as well. And it's kind of when to average down, and he cautions that you shouldn't do it if companies are over leveraged. So that's the sort of Spamel Deutsch sort of argument, but also if there's risk of obsolescence, and also you should effectively not put too much money in. He says the kind of value investors often get killed by the starting off with something that's a 3 or 5% position, and having kept putting money in, you end up losing 10, 15, 20% when they never really intended for it to be for that sort of size to be in there. So I think that's some caution there.
Yeah, and Wade got very large for me, but that was because it went back up. It wasn't on the way down.
Your cost price was was much more reasonable. Somebody's asking about position sizing. I mean, I guess I've written a lot about this, so maybe James, do you want to give us a feel for how you handle position sizing?
I try and scale into investments. So as I mentioned a little earlier, I obviously do my research first, but then I start off with a smaller position to really learn more as I follow the company more fully, and I obviously learn more, pick up bits of information, and then add to it as a result. But Mark, your position sizing from your book was really helpful to my thinking as well.
Thanks.
Because I didn't have a defined methodology for position sizing beforehand, and it was helpful to have that sort of intellectual perspective on how to think about it.
Thanks. Somebody, Stephen here, is asking about like the risk of acquisitive companies. Somebody have an example where that's sort of it says it's a sort of risk factor that you can have, and he's referring to a night as one of examples where he's that hasn't turned out well, I guess. So we've got kind of examples of that have gone wrong, or any thoughts on that?
I think it does increase the risk. I mean, I think JD Sports is really well run. I'd like to own them, but they've done 2 big acquisitions in America in the last year, and that makes me wary. If they work, that's fantastic, but it does increase the risk that 2 big acquisitions may not stretch the balance sheet, but if they don't integrate well, and America's can be quite a tough market to crack for some companies, it's currently put me off buying back in. Yeah, that would be my example.
That's a good one.
Results tomorrow, I believe, or this week, so we'll see.
I remember when JD Sports was a value share at a PE of 6 or something, and I never bought it because it looked like it wasn't going to do that well. So there's an error of omission for you. I mean, I would have sold it when I got to P of 12 or something. So again, there's a potential error of omission that I would have done. So
that's when I start looking.
Yes. Yeah.
So I think there's something to be said for serial acquirers. At least they know how to acquire companies, and they know what to look for, and they've got a proven track record doing that. I think in some ways it's a bigger risk for a company that's never bought something before and then does a major acquisition, because they don't really know what they're doing, and that one acquisition goes wrong and it could take down the company. I think Folex is an example of a company that did well out of acquisitions. I'm not so sure about the recent ones, but when you were valuing it, you could see that spare cash, and they'd already done a couple of acquisitions. This is back in 2019, 2020. And you could you can see they'd successfully bought before, and they had more cash and more capacity to buy more. So that was one of my reasons I actually bought, was because potential for making acquisitions and cash, EPS. What's the term, Mark? Come on. It would increase their EPS because it was out of cash.
Earnings enhancing. I think I like ones where they're making bolt-on acquisitions, and you can sometimes get like a sort of private public equity arbitrage. So I think SDI and Judges are Scientific classic examples of this, where they can buy quite cheaply in the private market and sort of take advantage of that different ability to issue equity at a premium in the market. So it looks like David's come back, which is good because we've run out of questions as well. So hope you will find that interesting.
Good timing. Great. That was excellent, guys. Always good to learn from your mistakes, and good to see that even the best of us make them. And I'm sure we've made quite a few. So there's no right to a mistake. I think we can all manage it. Thank you, all of you. And let's keep these Twitterati panels going. They're always useful. We'll find another subject and be back on in another month or so. Great. And here's David.
Thanks, David.
Excellent. Thanks, guys. Hi, David. You're on mute, I think, David. That's it.
Okay.
That's it. You look like you've lost weight, David.
Yeah, I was at the gym this morning. Maybe that did it. I don't
Gosh,
know.
one session at the gym. Oh my God. I'd better have a go at that.
Yeah, no, I was there this
Great.
morning.
Anyway, it's lovely to have you with us. And what are you going to tell us about today? You've got.
Well, it's a great honor to be here, David. Thank you. Well, I'm going to, in fact, lead on. It's a very good point to lead on from those folk. And I'm going to try and show you how I circumnavigate some of those problems. And I think if you could, in fact, distill the presentation down into a few words, it's how to go about making good decisions. Well, okay. Well, the first thing I have to put up, folks, is the disclaimer. I should have said that earlier. VectorVest is authorized by the regulator, the FCA. Although I'm qualified to give financial advice, I can't do so because I haven't done a long and a detailed fact find. So that said, we can move on. So what I do, folks, is that I have been a full-time trader since 1988. I traded on my own from 1982 to 1988, where I was the head of research and development for the De Beers company. I've got a PhD in mathematics, MSc in metallurgy, and a first degrees in mechanical engineering. So every day, I didn't today, I sit down, I do battle with the S&P 500 on a 30-minute chart. Done an awful lot more of that over the last little while because I'm not traveling. I also swing trade, mostly spread bets on mostly the US stocks these days, because there's been a great deal of energy there. They move. And position trade in UK stocks, and that's what I'm going to talk about today. So to make this work, I think, as one of the gentlemen said in the previous section, it's really, really important to find your own path. A methodology, and my methodology is a fusion between fundamental analysis, the search for value, at least that's how I define it, and technical analysis, which is the study of trends and turning points. And I want both to be coming to the party. And I don't like to be in a share that's sitting down below its 89-day moving average, and certainly don't like to be in a share that's below its 200-day moving average. My very first desk head, that was in South Africa. I lived in South Africa for a long time. Used to say that he'd never seen a share go broke that was trading above a 200-day moving average, and that stayed with me the whole time. The second thing we need to get right is money management. And a big part of money management, as one of the chaps said earlier, is position sizing. And at VectorVest, I think that probably my number one role is to keep repeating to people that risk is real, risk is out there. We see people, new people come along who don't understand risk. And unfortunately, it takes a smack or two before they understand it. So sizing your position is correct. I personally run a relatively small portfolio of high conviction positions. And then, of course, the third thing is being able to play the game, all about discipline, resilience, and frequently grit. Once you get 1 and 2 right, then for me anyway, maybe not for everybody, but for me, 80% of the exercise is simply playing the game. And at VectorVest, I like to separate it into 3 things: when to buy. And I firmly believe, folks, that there's a good time to be in the stock market and an awful time to be in the stock market. What to buy? For me, I want to buy undervalued stocks that are growing earnings strongly and safely. So it's a fairly conservative, for me, a fairly conservative approach. Everything I've got is in the portfolio I have, and I need to take care of it because in a day or two, I'll be 66. And then, of course, some idea of when to actually leave the party. Could be a trailing stop loss. And I certainly keep trailing stop losses in place. It could be some form of profit target, and certainly in the swing trades, I have a profit target mostly focused around the Fibonacci sequence, which works for me. May not work for everybody. It's a leap of faith for some people. So, and maybe this helps and runs on from the previous discussion. But myself and my trading partner, some of you may know a big fellow, a big Danish fellow called Tom Hogarth. He and I worked together for a very long time. And we looked at winning traders and we looked at losing traders. And we found that losing traders and winning traders think differently. And what happens, folks, is that a losing trader or a losing investor, when they have a winning position, they become pessimistic. They become pessimistic that the market's going to take their money away, and they snap at their winners. A losing trader, when they have a losing position, like this chart illustrates, become optimistic. And they average down. Now, like that young man earlier who talked about averaging down, that happened to me. In 1984, I made a heap of money for me at that time of my life in 82 and 83. And I took into one share, and I actually liked the brand, and I knew the people, and the darn thing went down, and I bought more of it. And I've never done that again. I pretty much gave back everything I made in 82 and 83 in that one trade, or that one poor investment in 84. Now, here's what I try and do. I'm very careful about risk. I understand risk. And my motto to all the VectorVest people is that don't avoid risk, but manage risk. I enter and I work out a stop loss. The stop loss needs to be in the right place. It needs to be well out of the traffic. And I size my position based on a stop loss that's well out of the traffic. If my entry is poor, then the stop loss can be miles away. If the entry is tight, then you can get away with a smaller stop loss and you can trade more shares. And ladies and gentlemen, as it goes my way, I want to add to that position. I add to the position when I can safely pull the stop loss up to entry. And that means I add to the position and I want to build a position in my long-term holds. In swing trading, you haven't got the same ability to add to a winning position, but certainly in these longer term position trades, I want to be 3 or 4 times bigger when I'm right than when I'm wrong. And that builds a huge risk to reward ratio. And to make this work for us, we need to get our hit rate up to an acceptable level, and we need to make a heap when we're right compared to what we lose when we're wrong. And that, putting those two things together in the speak of an American psychologist called Van K. Tharp, is called expectancy. And winning traders, when they have a winning trade, they become optimistic. They become optimistic the darn thing is going to keep going. Winning traders, when they have a losing position, become very pessimistic very quickly and get out. And it takes a great deal of awareness to get that right. And I've done an awful lot of work over the years in trying to get that right. And I put that across to the VectorVest people in our weekly meetings in all our groups around the country. And the reason that I'm doing more day trading than I've done in 5 years is that clearly those groups around the country are meeting online at the moment, which means that I don't have to travel. But we have groups strategically placed right around the country, great bunch of people. I lived in South Africa for 35 years. I'm back in the UK now, 5 years. I went to South Africa 40 years ago today, David, to play rugby for 6 months. And I said 35 years. Some cynic at lunchtime when I told the story said, did they play extra time? The VectorVest system of analyzing shares is what we're going to look at now. And a very controversial aspect is market timing. I firmly believe there's a great time to be in the market, an awful time to be in the market. Now, tomorrow at lunchtime, I've got a full hour to go through this, although I could easily make it run into 3 days, especially if I get involved in the trading psychology part and why it's so easy to make dumb decisions. Believe it or not, you've been hardwired by God and your evolution to make dumb decisions. And believe it or not, when you put the trade on, folks, and when you're managing the trade, you're two different people. Believe it or not, there's a different part of your brain working when that little bar is bouncing up and down. I'll talk about that tomorrow. My definition of value, folks, is the search for the true value of a share. And VectorVest puts a value to every share in the market every single day. And we believe of this fusion between fundamental analysis, what's the stock really worth? How safe is this earning stream? And technical analysis, which is the study of trends and turning points. And first prize is a share that's trading below the VectorVest valuation, that's growing earnings strongly, that's rising in price. I want to buy into it. I want to try and finesse an elegant entry with a stop loss well out of the traffic. And when the darn thing starts to move my way, and only when the darn thing starts to move my way, and I can get my stop loss up to entry safely, then I'll add to that, and I'll keep adding to that over and over again. And by the way, exactly the same principle works on the roulette wheel. Oh, if a red comes up, bet the red will come up again, double your stake, you can't go wrong. So relative value is quite a unique VectorVest measure. And it measures the long-term price appreciation potential of the share, 3 years long-term, in relation to what a corporate bond will pay in the same period. So it looks forward, folks, and it answers the question, is it better to buy a share on a PE of 50 than a share on a PE of 5? PE looks back, relative value looks forward. If the share on a PE of 5, if earnings are falling off a cliff, that can be a lousy investment. But on a share with a PE of 200, if the earnings are growing strongly, that can be a wonderful investment. And I'll go through the detail of that tomorrow. Everything on VectorVest is on a scale between 0 and 2. What we're trying to do is to give you all the information in one single number so that you can easily react to that information. And information is absolutely useless unless you can react to it. We put one single number to the safety and the predictability of the earnings. The algorithm looks at the balance sheet, income statement, cash flow statement. It looks at sales, margins, dividend growth, dividend safety, sucks them all up into one single number. And we put a number to the trend. There's actually 2 numbers to the trend. That's the short-term trend. And then we put those together into the master indicator VST, value, safety, and trend. And as a default, all of the shares on VectorVest are sorted by that master indicator VST. Again, it puts fundamentals and technicals together. We calculate a stop loss every single day, and we put a buy, sell, or hold to the share every single day. And that's what my default layout looks like. I'm a shareholder in this company. It's a copper play. I'm sure many of you know it. There was the last buy signal on VectorVest. Now, that's the share price in candlestick format. That's our valuation. So it's undervalued. And over the last year, it's grown earnings strongly. Flattened off a little bit now, but growing earnings strongly from, I can't quite see it, but doubled over the last year. I started life as a technician. As you can see, I can't stop drawing in trend lines. That's not for everybody, I know, but nevertheless, I'm holding a position in this. Since down around here, those of you that are technicians can probably see this rounding bottom, which is an exceptionally strong pattern that's worked well for me. This is Watches of Switzerland, another classic VectorVest buyer right across here, and earnings per share growing strongly, and I've added to that position quite a few times along the way. That would have been a really good place to have added to that position at 6, just here, where this resistance becomes support. I put on 3 moving averages. I don't put them on the chart because if you've been looking at the darn things for 25 plus years, you can see where they are. And that is my default layout. And that's Volex as well, another classic little entry there. Now I'm running into the next presenter's time. I have an hour tomorrow, David.
You have, and I'm absolutely certain we've got nearly 400 on the webinar at the moment, and I'm sure lots of those will want to join you tomorrow.
Well, I hope so, folks. I think that I'll be able to. I think that I'm happy to allow everybody that comes to Mello to test drive VectorVest for 30 days for a nominal 99 pence. And
sounds a bargain.
Well, you can't go wrong with that.
You can't.
It's vectorvest.co.uk/Mello. But by all means, if you can't come along tomorrow, you can avail yourself of that offer now. But it'd be great to see you tomorrow afternoon. I really don't know what happened to that.
Don't worry, David. The link for everyone is on the website, on the web page. So they'll be tomorrow, and we'll see you then. I'll be there too.
Okay.
Great. Thank you, David.
David, thanks very much. Bye-bye.
Welcome, Vin.
Hello, hello.
Welcome to Mello. First time that we've had on our show, and such a shame in my case that I missed out on advanced computer software. Years I was thinking I should be in this and just never made the move. And yes, you're very well known for that amongst a lot of our investor group. But the other thing you've always been crowned as is the Queen of Tech.
I think I'm just old.
Yeah, maybe you can tell us, very happily if you want to get rid of that term, but how did you come amongst it?
I think it's just partly because I've been in the software technology industry for such a long time. And for those of you who know, my first vehicle was Keywell Systems, and my second one was Computer Software Group. My third one was Advanced. And we were very fortunate to deliver fabulous results for all of those companies. So to be quite frank, so I don't know where it came from, but it seems to have stuck for a period of time. I'm more than happy for somebody else to take it. So I'd love to see some amazing females come up and take the realm of technology, because I think there's a lot of great women that deserve it. But there is I think part of it is longevity and part of it is returns. I mean, those who remember, Keyworld came out at 1.2 billion in March 2000, and Computer Software Group went private and then sold to Hellman & Friedman for 500 million in 2007, and Advanced did what it did. So yeah, it's been a, as I think I was saying to somebody earlier on, that I consider myself incredibly fortunate and blessed to be quite frank, to be in the technology sector for the last 30 years. And then I look at what's happening for the next potential 30 years, and I'm thinking, oh my God, I wish I was 22 all over again, because there's just so much happening again, isn't there? So just phenomenal opportunities.
Well, you've been an absolutely fabulous role model for women and men. I mean, you know, just everything that you've done seems to have been done in a way that's given you success. I mean, how many companies have you actually been involved with overall, would you say? How many have you acquired?
Over the last 30 years, probably about 70, 75, something like that.
Wow.
Most of them actually from, I hardly ever buy from private equity. I think I bought 2 from private equity, but the rest, I'd say, 68 to 70 of the 70 would be from founders. And for very particular reasons, because they're the best businesses out, to be quite frank. Your UK, US US calls it Mar and Par shops, but in Europe, we have a lot of great businesses that do really well, generally get to 3, 5, maybe 10 million revenues, and have done all the things they wanted to do. They've paid for the school fees, they've got a great home in Spain, they've got everything they want, and they want to do other things with their lives. And those businesses are usually the best, because the founder will often have looked after the customers really, really well, and made sure their people were really looked after, and the products were fantastically well kept on ahead of the game, but maybe just didn't take as much risk on the front end sales engine or M&A strategy, etc. And so what we end up with is a fabulous foundation, but which we can build on. And that's been the mainstay of everything I've done, to be quite frank. And generally, you'll often find that there's lots of these businesses in a vertical, and they'll compete against each other because they compete against each other. And it usually takes somebody else from the outside to come in and look at it and say, well, hang on, if you put them together, you get economies of scale. You don't have the arguments between parties. You use the best products from each of the components. You make sure the customers are really looked after, and you support them going forward, and you put the development to a core product that leads forward. So, and suddenly you've got an industry that used to compete against each other, doing its absolute damnedest and best to do the best thing for the customer, combined, use their talent and skills in a single vertical rather than, bit part players in a series of the verticals.
Yeah. I mean, when I was younger, I never heavily got into tech. I operated the same idea as you. I looked at family firms in all types of sectors, and I was very happy with them. I know when I went to visit them, I always felt, well, you don't really need the non-execs, because with it being a family business, you had members of the family that were always watching over it. You had the grandfather that maybe set it up. He wanted to make sure it didn't go crazy after he'd left. And in a sense, you were getting a very good culture. You had lots of people working that were happy being in a family firm.
No, amazing. But what actually happens often is that's a phenomenally positive scenario until the family is the blocker on its growth. Okay. And when you get so people are always more worried about something if they think they've got something to lose. If you've got nothing to lose, you go for it. Yeah. When you have something to lose, you take a little bit more care and attention, and maybe become a bit more reserved about what you do. And that's fine 99% of the time, but often you almost put a barrier on anything else. And people, I see this a lot where you've got talent coming through the organization, and they'll come with great ideas to the team, to the board, and the board will say, yeah, we tried that. Yeah, we tried that. And what happens is that level of talent will only come to you 2 or 3 times. And after a while, when they don't get a move forward, will stop coming to you. And so the ideas stop, and so you have a great business and great customer base and really loyal employees, but that kind of opportunity to step up the growth just seems to dissipate. But, that's not a negative. I'm not saying that's a negative. It is just cycles. And often it takes somebody else to come in and say, here's the next stage.
And that's exactly what you did. So maybe looking at 70 acquisitions, that is a big number. Have you had any?
Over 30 years.
Yeah. It doesn't matter how long, it's a big number, but how many of those would you say you had a really difficult job, or was there any that you could say actually wasn't a good acquisition, really?
I think there was only ever one, and to be quite frank, it was glaringly obvious there was going to be an issue before you started. And but you know, and this was at Keywell, it was in the 90s. Those are people who remember this. We bought a business in Germany, and of course none of us could speak German, and so we were all trying to learn as we were trying to buy the business. And the first business we bought in Germany was a great success, and the second business in Germany almost killed us, and that was because we got over eager and didn't hear what we should have heard, just heard what we wanted to hear. But it was the best lesson you could ever have, to be quite frank. You know, the issue with winning is that if you only ever win, you never learn anything. Yeah, if you can go through some really tough times, that's when the learning happens. And that's when you realize, you know, the ego is going to be put to one side, and you have to go back to basics, look at what you're doing and saying, is this the right thing for us? And as I always say to people, you know, you have to kiss an awful lot of frogs before you get a prince. So just keep kissing the frogs, and make sure you at least can speak the language you're supposed to be dealing with.
Yeah, I mean, it makes it sound easy when you say there've been 70, even over 30 years, but you've probably seen 700 and had to turn away 630, no doubt. Oh,
absolutely. No, absolutely. And in fact, it's funny because everything comes around in a cycle. So, I mean, I'm seeing businesses being bought now that I probably looked at 10, 15 years ago. And it's quite, there's a cycle, you know, everybody has their turn and it comes through, but yeah, I mean, and actually now you know, this, as you've seen the volume of M&A that's happening right now, it's just off the planet. And partly because there's just so much money frothing around, and partly because, well, because everybody thought the CGT rule was going to go up. That's what everybody's doing.
I did get the feeling a lot of businesses were sort of almost up for sale for a reason. Up to the April deadline, as it were. Yeah,
and it'll be interesting to see whether that volume, you know, comes off rapidly or not. But right now, I mean, there's still, you know, we used to say, you know, you would talk about multiples of 10, and then the 10 became the 20 became the 10, and now the 30 is becoming the 20, you know, so it's all a bit crazy. And that has a knock-on effect, because you just have to get to a stage where you start to accept low returns on businesses over a much longer return. I mean, the kind of returns you'd expect in a PE firm, for example, historically were 22 to 25% IRRs, if not higher. And now you can see some of the bigger institutions saying, maybe we can't get to that. Maybe we can get to 12 to 15%, you know, because we're going to have to hold them longer, and we have to balance more, and we have to average them down more. And so, you know, this is great for now, so enjoy it, but be aware this is all cycles. It comes around, you know, I'm old enough to having seen 2 or 3 cycles. And whilst this is wonderful and you enjoy it for now, just be aware there's a cycle.
Yeah. And given, actually, someone's asked in advance of the show, given the current software multiples, and clearly you're probably seeing them at really high levels, do you feel you may have sold advanced computer software too early?
If you'd asked me, yeah, probably I did. The reality of it is that I've never sold a business. I mean, people always think I've sold, but I've never sold a business. People have always come and bought it. And at the time, there was a bunch of my team had made sure they were well rewarded in terms of equity, etc. And they were all doing rather well, and they could see their pensions and their lifestyle sorted for life, you know. And so whilst you might not want to take it private or do something at that stage, the reality of it is you have to look after your people. And I'm happy to say we did the right thing. It was all great. I mean, I don't know if you know, but Advance sold again for 2 billion last year.
Oh.
Yeah, so it's done, I mean, and it's done fantastic well, which is a great credit to the team for developing and building a business that, in fact, all of our businesses, Keywell is now called Blue Jay. It's part of Francisco Partners. Computer Software Group was part of Iris, and now it's part of Advanced again, and Advanced is still part of Vista. So you can see that the businesses have all continued to thrive and survive, which is a great testament. What I tend to do, and I do this with every every time I finish in one particular business, what I always do is I say to myself, okay, so how much would I have left in the business, and what would I expect it to do if win, and what would I have made if everything had gone right? And then I go set myself that target to beat, and I do every time.
Oh, well, that's good.
Yeah, so I do every time. Because actually all you do is you clear the decks and you start again, and you look at new businesses afresh. I mean, I've been very fortunate. Gosh, in the last 2-3 years, probably done 3 or 4 businesses where I've got a 5x out of them in 2 years, which is great. But that's fine for individual businesses. It doesn't build the bigger business that you see opportunities at.
Yeah. So give us an idea of the sort of boxes you like to tick when you're looking at either an investment in a business or a sizable stake, or even taking over a business.
Well, if I'm looking to take something over, it always has to follow the same characteristics. It's the same thing I've done for 30 years. Nothing's changed, guys. I mean, I'm if anything, I'm as boring as they come. And what I mean is I'm looking for really, resilient software businesses with lots of sticky customers and really high free cash flow and recurring revenue that's there, and the opportunity to cross-sell and upsell, and barriers to entry that are quite hard for somebody else to try and hit, generally where it's founder owned, and where often it's in a fragmented market, whereby the ability to consolidate that fragmented market would actually mean you create some synergies and some economies of scale, and gives you a greater control over the customers rather than the customer controlling you. Because if you're small, if your customer says jump, you say how high. If you're the main player and the dominant player in that market, you're in a much better position to put yourself in a stronger position to negotiate. So I don't do anything, and that's exactly what I've done for the last, 30 odd years. So if I'm buying businesses, that's what I tend to do. If I'm investing, I do different things. Again, I tend to look for technology, or I look for an opportunity where technology will transform the business. So a digital disruption play where, the value of the business is such that it's undervalued, but a story that would allow digital transformation to happen and a driver towards a technical play would suddenly change the dynamic. And you can see that happening a lot because, they call it software eats the world, but, you can see the businesses, everything is becoming tech enabled and being tech enabled. And that means not just technology as a disruptor, but also technology as a platform for growth, for data analytics, for reporting, for just bringing more value to the table. And that you see the transformation happening, and you can see it across multiple industries.
Now, when we look at individual investments, and you've got a few that you're noted for at the moment, what can you tell us about some of the ones that you're involved in?
Which one? I mean, I've got a number of smaller shells, and I'm in MNC Saatchi, and I'm invested in Softcat, and I'm invested in quite a lot because I think at this point in time in the cycle you have to be invested. Yeah. Spread it as always. Be careful. Don't do anything silly. Normal stuff, But yeah, I think you have to be invested. So, I mean, Softcat is a phenomenal business in its own right, as you all know, and you'll see the results. It just seems to blow the lights out each time. The MNC Saatchi is a classic digital transformation story. You can just see where it could go if you can transition the business to more of a digital focus, and it's all largely there. It's just not showing the numbers in the way I would have thought they should be able to, and I clearly think there's massive upside on that one. Then I've got a bunch of shells. I've got SWC that people will know, Someway Capital. That's a 7 to 10 million valuation cash sell, and that's really for doing SaaS type roll-ups for small SaaS businesses, and we've got a number that we're interested in. The kind of stuff we've always done, accounting, HR, payroll, back office type functionality, which is transitioning towards a technology play. There's a bigger shell called Advanced. So if Someway is about 10 million, Advanced is over 130 million of cash, because there are lots of small little transactions you can do, but the big ones need real money. And so for Advanced, we're really looking at things that are in the order of 200 to 300 million in value, including, founder rollover and a whole bunch of other stuff, where it really wants to go to the next level. So it's something that's going to be 200-300 million, wants to get to $1 billion, and that kind of piece. And then I've also supported from a distance a US SPAC called Plum, which is really not me, but it's a much bigger team out in the States. And the reason for getting involved with it was purely to understand the difference between the US version of SPACs and the European version, because I do think there will be a big push for more and more of the kind of SPAC idea to come to Europe. And the key difference in here, if you have a cash shell like Advance, for example, your investors have backed you, they put the cash into the bank account, and you have got the cash to go and do the transaction. Okay. In the case of, and the cash stays there unless you as a board choose to hand it back or do something with it. In the case of SPAC, often what happens is that first phase of the SPAC launching is investors that, when you get to a deal, may or may not consummate it. So new people may come in and take over their position, but the 200-300 million that you raise at the beginning may go forward, but then again may choose not to. But what it does is it allows a institution, a organization to go to you and say, we have the money. If this is the right kind of deal for us, we'd like to back you, and then go and raise more money in the marketplace. And there's just a volume. I think there was 278 SPACs listed last year in the US. I mean, crazy numbers. And you'll have seen I'm sure you'll have seen the fantastic job that Alex Chesterman's done with Kazoo. So and we'll see how that pans out. But that's that's 180 million turnover business that losing 80 million, and is listing as a US SPAC for $7-8 billion.
Wow.
Yeah. Now, all I can say is I missed that one. So maybe I'm missing something here, guys. But I mean, and Alex is a superstar, so he's clearly picked up on something, and whether that will come to that kind of level here will come into Europe, I don't know. But I would not be surprised if we saw a level of SPAC activity in Europe sooner rather than later.
Yeah. And with shells, which effectively advanced ADVT seems to be, isn't it a case that you have to have invested in something within a certain time, or you're not allowed to trade on the market anymore?
Normally 2 years, but you have the opportunity to go back and ask the individual institutions whether they want to be longer. I mean, to be quite frank, if we can't find something in 2 years, as I always said to people, I don't want your money. What I want to do is do something amazing. And if we can't do something amazing, please have your money back. I'm not interested in taking anybody. I've got enough. I don't need anybody else's money. I want to just create something that we're all proud of and we'll do a great job with. And if that happens, then we'll have all done fantastically well. But what we're not going to do is chase things just because there's money in a bank account. No,
and I guess as the time technically runs out, you don't want to make a rash decision. You want to do a good one. So
I never do that. I don't fall in love with deals. No. I've never done that, and I won't start. What I do is I'm looking for things where they are a platform play that you can do something dramatic off the back of. And if you can, that's the exciting piece. That's the thing that I always say, don't chase anything, just always do the right thing. If you do the right thing, right things happen, and there's no short-term get rich quick schemes for anyone here. This is just purely a case of, can we create something that could be absolutely amazing with our support? And if we can, let's go do it. And if we can't, well, thank you so much for the opportunity and God bless, but here's your money back.
Yeah. And I'm going to go back to M&C Saatchi, because one of our well-known investors who looks at formations on the chart and looks at changes within a company to see the key moments when it looks like things are getting better. He spotted M&C Saatchi a couple of months ago. We mentioned them on the show. I must admit, I invested in them. I've had a look at it. Looks exactly as you say, that, there's an old business, if you like, an old style business that's now doing everything it needs to do to get into the sort of modern world, I guess.
Well, I mean, to be quite frank, the MSC Saatchi brand name is phenomenal. I mean, the brand itself is worth the value of the business, the market cap of the business right now. So everything else is for free, as I look at it, you know. So I think the gentleman earlier on was talking about value invest. I mean, I'm looking for great businesses that you can do stuff with. The client base is excellent, and the team is fantastic. The reality is they had a hiccup, they're over it. Let's move on. And now the real opportunity is, can we take that vision from creative and the fantastic, you know, in sports and entertainment and performance and everything else they have, to the next level with a digital platform. And the way I look at it, and I know that they probably hate me for saying this, but I mean, I'm sitting here looking at things like Kinner Carter and Next 15 and S4, and I'm saying, hang on a minute, how come that's 700 million market cap and we're 180? Give me a break. There's a disconnect there. Now the other Next 15 is a phenomenal business and it's doing all the right things, but it's a role model who we can go look at, you know, and you can see that particular organization has moved more towards digital. Yeah, there is a story here to be played out. We'll do our best to deliver on it.
Yeah. Well, you're in there, so it gives me extra.
Yeah, that doesn't mean to say anybody has to listen to me.
No.
I will just do my help as best as I can.
Yeah, and I think you're a non-exec there, aren't you, Vin?
Yeah, I just gone in as deputy chair. Thank you to the guy.
Oh, great, excellent. Well, I mean, overall, so we're seeing and hearing of you as an investor. We're seeing you running companies, and here in that one as a deputy chair. What's your favourite role, and which do you get the most enjoyment out of?
Oh, running businesses. To be honest, I love all of it. Everything has a different flavour. I mean, I go on as non-exec because I go onto boards where it is different to my norm, and I learn a whole bunch of new skills that you can bring to the table elsewhere, you know, and vice versa. So, you know, always go and do something that keeps your brain active. And people always say to me, why do I do so much? Well, I think, to be quite frank, I've been married 30 years and I want to stay married. My husband would boot me out if I didn't do it. He knows I have so much energy. I drive people nuts. And so you can imagine COVID.
Yeah, lockdown must have been difficult.
Yeah, but I mean, what I mean by that is the wonderful Prince Philip, Duke of Edinburgh, has passed away. And what has been amazing, if I look at his life, he's 99 and boy, did he live it. Okay. And this morning I put a sign up on my desk saying exactly that, saying, you know, you have one life, make it count.
Yeah, true. So how many hours a night do you sleep?
7 solid. I am out like a light.
You're tired out, of course.
Either that or yeah. Yeah, but no, you know, it's look, how can I not want to do this? If you think about it, we've just lived through 30 years of amazing technological advances, and we look like the next 30 years is even going to be more amazing.
Yeah.
And I just don't want to waste a minute of it. I just think the opportunities are fantastic. And as long as you don't get ahead of yourself and you don't get too egotistical, just do the right things. We're incredibly blessed. My husband always says that he always says to me, you won the lottery just being here. And what are you on about? Well, you win the lottery just being in the UK. The rest of it is a bonus. Now make the most of it. And if you think about it, the opportunity to invest, to partner, to grow businesses, to talk to fantastic businesses across the spectrum, what's there not to like?
Yeah, we are in a great environment here in the UK, especially. I mean, you know, when you discover something or you create something, you know, you've got an equal chance of getting it to market and being able to do everything you need to do.
I don't know whether you were in or an outer, but the bottom line on Brexit, I hope that the one thing that Brexit does for us is it forces us to become, as a country, to become we're very innovative and we're super smart in lots and lots of ways. Our ability to go export and big is the thing that we really want. And I think, you know, that's the opportunity, because the UK market is only of a certain size. If you can go from that to a global market, and, you know, why not? Technology allows you to. You don't have to worry about, you know, the data infrastructure, you've got AWS. You don't need to worry about having offices everywhere, because guess what? You've got websites. There's so much you can do that says, don't just focus on the territory here, talk about the global opportunity almost immediately.
Yeah. I mean, in the situation that you're in, I mean, clearly you don't want to have time on your hands. Many have mentioned to me about Dragon's Den and why on earth have you not been a dragon? Something that would have interested you.
I'm probably too much for a dragon already. No, I've been very fortunate. I've been asked 2 or 3 times. The reality, A, I'm just too busy and I love what I'm doing. And B, I'm an investor. I'm a full-blown investor. I couldn't cope with being an entertainer. And the dragons that we have do a fantastic job in doing both. But it sometimes borders on an entertainment show rather than an investment show. And I'm more interested in being an investor. Yeah. I want to see great individuals create great businesses. And I'd love to say I'm part of that.
Yeah. And I'm sure there's thousands of dragons out there that are just as good. It's just that they're in a TV show effectively. And I don't know where you want to be in full view in that.
But there's some great people. I mean, you know, as it happens, Theo Paphitis lives on the estate that I live on, and you've got some great role models. And in many ways, if it makes individuals step up and say, do you know what, I'd like to try that, then do you know what, it's won. That's the right decision. That's the right thing. That's what we need. We need people to say, do you know what, I can do that. Yeah.
Well, you'll be pleased to know that David Hornsby was on our show a few months ago. He's retired, many know from IdeaGen. He says that you were great at the start of his career and helped him a lot. And I'm sure, you know, lots of people will have, over the years in many companies, have seen how much you've helped them.
But you know, David's a fantastic guy. And I remember many years ago, he came to see me and he was asking me how I did what I did. And I just told him, and I said, well, this is what I do. And I said, there's nothing clever about it. It's called common sense. And I said, but the difference is most people don't do it. And he, smart man that he is, took it on board and went off and said, I started IdeaGen. And look at that. So, you know, all credit to him. So, you know, it's all very well talking to somebody and taking ideas. It's taking action that makes a difference.
Yeah. And we've had a good few years with technology and healthcare, especially in the last 2 years. I mean, they've come on leaps and bounds. I mean, the things that we do now with technology, anything that you can see into the future that you think is going to be really big?
Well, it's going to continue to be big is cybersecurity, data analytics and reporting, digital disruption, you know, platforms, much more so, you know, because you can see it's happening everywhere. I mean, Microsoft talked about, Satya talked about, you know, 8 months of COVID, and we ended up moving the technology industry across forwards 8 years. Yeah, absolutely. You know, and it'll be tech everywhere. Tech in your cars, tech in your, I don't know, in your hearing aid, tech in every. So there is a comment that talks about, you know, software eating the world. It's absolutely doing that. And if you could align yourself with that, then, you know, the value creation that brings to your entities is a good place to be.
Yeah. Well, let's have a look at a few of the questions that have come in from the audience. And I can tell you, we've got nearly 450 on the webinar. So certainly quite a few questions for you.
Okay.
Leo asks, I see you're a significant shareholder in FinCap. What's your, yeah, you might have forgotten though. What's your investment thesis there?
Well, interesting. That was slightly different. I have known Sam Smith, the CEO and founder of that business, for many years, and always rated her highly. And one of my big things is to back women where I can. And I'd known Sam for many years, and she asked me to come on the board. And when I come into somebody's board, I always say to them, well, I'll come on the board, but there's no point in me being on the board unless I'm invested, you know, because then I've got skin in the game and I'm doing the right job. And I had the opportunity to invest quite heavily and at the IPO, and that's what I've done. So I think I'm the second largest shareholder. So
right. They had results the other day, I saw, a trading update.
Done really well. Yeah. So great lady.
Another good one for you. Another of the attendees is asking, as an investor, what are Vin's top 3 tips for assessing a great founder CEO? What does she look for other than the obvious integrity, etc.?
That is a really good question.
Oh,
I look for, I look for people that love their business, okay, and that they will go out of their way to do the right thing by their customers and their staff. And if you've got that, everything else sorts itself out. Yeah. I've just been invested in a business called Pythagoras for the last 2.5, 3 years. And Julia and Emma are the husband and wife founders. And I'm not joking. What an amazing team. You know, they spent 20 years growing their business, doing a fantastic job. The employees, they're supportive of their employees. They just have created a great business that people want to be part of. And to me, that speaks volumes. And those are the people that, you know, when they want to grow to the next level and you can give them the right kind of guidance, they go with it. And yeah, that's it. I mean, that's it. Great passion for their business, the real vision, and, you know, bring both their staff and their customers with them.
yeah. And when you visit the businesses, naturally you're going to meet the CEOs and the founders. Do you actually go a bit deeper and get to chat to some of the staff that you can see around?
Always. Funny enough, I always, oh no, I'm going to let you my secrets now. I can't do this. So if I go and see, if I normally turn up about 6 o'clock, 7 o'clock in the morning, and I sit outside in the car park and watch what happens. And if you see people bouncing in and it's, you know, they're keen to get in early and get on with things and do things, just watch what happens in reception. Just sit in reception and see what happens. If there's an energy about the business and there's a motivation and a drive, you will know a lot about the business before you take it forward. Okay. I have to tell you, there's one business, I actually didn't buy it because I didn't get it. Somebody beat me to it. But I remember going into reception and I literally, it was like the receptionist had just woken up. And I knew there was a fantastic value in that business, because if she was so slow, yet the core business was quite strong, you could guarantee that everything was at a treacle pace. And, you know, if that's your front of office, then imagine what's sitting behind it. So, yeah, so my secret is always to just sit and watch. I mean, to be honest, when I first went to see M&C Saatchi, I sat in their foyer for 3 hours just watching. And that's what told me that the underlying this was a fantastic business, because the vibe that was there was just fantastic.
Yeah, that's good. I mean, I think most investors like to try and find a little, what's the word, a sort of an edge in their information. You know, I mean, I used to watch a house builder because I was heavily invested in a house builder. And it was a small one. So I used to ring up each of the show houses every few weeks and check how many were still available, so that I knew how well the site was going.
Ah, yeah.
You know, it's little things like that that tell you about a company, and also tell you about the front facing person, you know, how good they are.
Yeah. I mean, if you want, the numbers will tell you the numbers. The real value comes in when you talk to customers and to the staff. Okay.
Yeah.
And, you know, I always do what I call a secret shopper.
Yes.
So if you can't do it, get somebody to do a bit of research in that sector, or because a lot of people have their customer list on their websites, you know, and it doesn't take very much, and or ring the company up and ask as a potential client, see what reaction you get, you know, and that will tell you an awful lot.
Yeah.
None of it, as I said, you know, none of this is complicated. Okay, the numbers might be complicated, and you know, you have the accounts may be detailed, etc. But that's all. You should expect to know that. And if you don't know it yourself, make sure you have somebody who is really competent in that kind of stuff, and make sure you listen when they tell you the truth about the business. But in the end, as long as you don't fall in love with it before, you know, so you can always walk away, you can learn an awful lot about a business before you do anything with it in terms of investing. Yeah.
And Steve here asks, you mentioned data analytics as a key driver. Any companies you're looking at who can provide this, or is it more where companies are starting to leverage data for growth?
Well, there's quite a few. Some of them are quite highly valued already, I'm afraid. So people like Kainos and Panoply, etc., in that field. But there's quite a few around. You're going to find more and more of this stuff happening, because there is only one route now. And the value in the data is huge. It's funny because I happen to be on the board of Bunzl, and I was talking to the chief exec earlier on today, and another amazing business, and it's, I don't know, what, 10 billion valuation, something like that order. And yet, if I look at the business, I can see there's like another whack of value just in all the data they hold that they probably haven't even used as well as they could do. And, you know, it'll take time, but they're smart enough as an organization to know that they have it, and they will work in that direction. So it's about, you know, not just where you are now, but where that volume of data could take you and what you could do with it and how you could best use it. But you're going to see it everywhere. I mean, you're just going to see it everywhere.
Do you think there are companies out there that almost could be acquired for the data that they have rather than, you know, having to start again?
Yeah, but the ones that are interesting, where the data would be really valuable, you probably wouldn't be able to get hold of, not because somebody will have ownership and should have ownership of that data. So, you know, healthcare bodies, they'll be very wary about using access to their data, you know, and certainly not to give to pharmaceutical organizations, etc., or government kind of data around. I mean, it's scary because there's an awful lot of information around there about everybody, but you just have to be careful about who can get access to it if it's really privileged stuff.
Yeah.
Having said that, you know, cybersecurity is another big growth area because, with all due respect, you know, the more data we have, the more challenges we give ourselves in that capacity.
Okay. And Imran asks, hello, Vin. Israel is a leader in cybersecurity.
Yeah.
What do you think of buying London-listed AIM stocks that are actually based in Israel?
Always worth getting. I mean, we're doing some work with Rothschilds, and of course Rothschilds are very well embedded in Israel, and so I spent some time out in Israel looking at some of the great technology companies, and they are some great technology companies. I mean, they come at it from a completely different angle to us. They literally, from day one, you know, you come out of the military and you literally start a company with your cohort of people from the intelligence unit, and off you go. Most of the Israeli companies that I see come out of Israel, they tend to go straight to the States. Okay, so the first question I would ask is, forgive me for this, and whoever, if there's any Israeli companies here, you know, what did they not? Because the US is the big market for, and there is a route that has been well established. You know, it's a bit like the Irish organisations. Irish companies often go to the US as well. There's an established route. So if they've come to AIM, why have they come to AIM? Could they not go to the US? Yeah. The volume, you know, we have a different, in Europe, we have a different proposition in terms of the volume of money we'll throw at something. That is changing. Okay, that is absolutely changing at the moment. But so I'd ask that question, you know, but there are some great technology, and there are a number of the Israeli cohorts that come in and do startup type fundraising here in Europe. So before I jumped into any of those companies, I would literally spend some time just sitting in on all those early stage entities and listening to lots and lots of stories before you leap in. Yeah. And if you leap in with something like EIS so that your downside is protected.
Yeah, yeah. And I mean, do you think our investment markets are good here? Or would you say that there will be an attraction of going elsewhere? Do you think we're doing the right things here?
No, we're doing a lot of we are doing a lot of the right stuff. And I think that Rishi Sunak has definitely talked about, you know, giving us greater opportunity. And I have to say, there's not been lack of funding. You know, there's an awful lot of money being thrown at the, I'd say at businesses, but sometimes often just at the wall. And I think you have to be, when that's happening, you just have to take a double take and make sure that when you go into something, you go into it for the right reasons.
Yeah.
I mean, a lot of the biotech stuff now is just shooting off the planet, and there's a lot of great stuff around, but all boats rise in a rising tide.
Yeah, they do. They do. Well, a young investor here is asking, Vin seems amazingly knowledgeable about companies. If she was starting with just £1,000 in a listed company, what criteria would she be looking for to have the best chance of a multi-bagger?
Well, if you only had £1,000 and that's what you were doing, I would not put it into a single stock. I'd put it into an ETF.
Yeah.
Yeah. I mean, to be, no, understand the market you're in, understand the company, try to understand where its positioning is going to be and where it can take it. Why do you think it's undervalued? And, to be honest, too risky. If you've only got £1,000, put it into an ETF.
Oh, you're feeling fearful for them with just 1,000.
Well, no, because I'd feel really bad if somebody took £1,000 and invested in something. I'd feel obliged to underwrite it or something.
Oh, no. You don't have to give a name of a company, just the sort of things that you'd be wary of, or things that you
make sure you understand what the company does, and check out where its normal averages would be, and whether there's been any blips or whether there's been any unusual share structures. I just feel odd because I'm not a tipster.
No.
I don't know how to.
And there's so many things, aren't there, to look for? But
yeah, and I think the gentleman beforehand talked about good investors and bad investors, and I think he's better to listen to than I am. So.
No. But you've been great to listen to, Vin. I can assure you of that. And I will just leave you with one thing that a broker said to me, actually, when I said that we've got you coming on the show. Oh no, you don't have to be worried. He said she really is a force of nature.
That's very kind.
And, I think you've proved that you've got such a great range of knowledge over the years that you've acquired. And it's been great listening to you.
Well, thank you.
We'd really love to get you on the show again, I'm sure. Lots more questions to answer, but in many ways, it's good to leave a little bit for another show. So thank you very much, Vin.
Thank you, David. God bless everyone. Have a great evening and enjoy the rest of your session. But thank you.
Yeah, we've got nearly 500 on here now. So I think they've come away from the shopping and the pubs and the hairdressers at last.
Oh yes.
Yeah. Yeah.
Great. Did you notice it was snowing here today?
I know, it's crazy.
It's snowing here this morning. I can't believe it.
I saw some pictures on Twitter where people were having their first meal out in the pub and it was snow alongside them. Yeah.
Anyway.
Great.
Thank you everyone. Thank you so much. And
our pleasure. Absolute
right.
pleasure. Thank you, Vin.
Take care. See you soon.
Great. Well, Alistair, we have you. It's always good to see you. We're having a fun show, and I'm sure you've got plenty to tell us about Aquis. You just had results out.
We have, and I thought I would, for everybody on here, go through the results today and then answer any questions there are. I'm absolutely delighted to follow Vin. I very rarely sort of am so impressed by sort of 45 minutes of just pure entertainment. I love her philosophy of life. Yeah. I love her attitude to business, and there's so much that I commend and hope that we sort of aspire to at Aquis. So it's a difficult act to follow, but I'll certainly do my best.
Well, you probably heard she went into FinCap. You just need her as an investor in Aquis, and
well,
following you straight away.
Well, anyway, what I'm going to do is try and share the screen here, and get the PowerPoint up here. I don't know if you can see that yet.
Yeah, can see that. A bit bigger.
Try and get that completely up there. Can everybody see?
Yeah, you've still got your slide showing on the side.
Yep, I'm just about to change that. So hopefully you've got that now.
Great.
Trouble with running a technology company is everybody expects you to be able to run PowerPoint without any issues. But look, welcome. Thank you very much indeed. David and all of Team Mello, it's a real honor to be here again. I would like to run through the results because as a sort of founder of a business, I think it is a great moment when you actually put your first profits out there for your investors. Just to start with, I thought I would let you just describe for those who don't know Aquis Exchange PLC what we are. We're one company. We operate three clear divisions. We have multiple products. We operate in France with an MTF regulated in France. We're also regulated by the FCA in the UK. And we're probably best known for the Aquis Exchange business, which is the 1,700 stocks that we trade across the whole of Europe in 15 different markets. We've obviously last year bought the Next Exchange, which is now rebranded as the Aquis Stock Exchange, and we're going to talk a lot about that and how we are positioning ourselves to be a NASDAQ of Europe. We've accepted the fact we bought a license, and there's a lot of change, a lot of both technology change and rules change that we brought in. And we run a technologies business. We license our technology, and we have done quite a lot over 2020. So I will go through some of that. This year has been a strong year for us. And you've got to remember, obviously, an incredibly difficult year for the world. I think with the backdrop of not only Brexit and also obviously what happened with COVID, it's not easy to grow a financial services business. But our core exchange business successfully transitioned on the 4th of January to our Paris office. 99% of our trading left the UK in EU 27 stocks and moved to Paris without any issues whatsoever. We acquired, as I said before, the Aquis Stock Exchange, and we've transformed that, and we've delivered a world-leading proof of concept product, a proof of concept with the Singapore Exchange and Amazon Web Services. And again, I'll describe that in a little bit more detail as to why that is really transformational for us. Our liquidity. Now, many of you probably never even heard of Aquis Exchange, but we grew liquidity, which literally is the best bids and offers in these top 1,700 stocks across Europe, to 23%. We are the largest provider of liquidity of any exchange in Europe. That's bigger than the national exchanges. It's bigger than our direct competitor, the CBOE. We grew market share from 4.2% to 4.7%, but I'm absolutely delighted to say that we've smashed through the 5% market share in March, and actually up to date in April, we're above 5.75%. So we really have started to motor in the way of market share growth. We grew and we charge, and what makes us different to any other exchange in the world is that we operate a subscription model. In other words, we don't charge people every single time they trade a value of that trade. We charge on the message traffic in exactly the same way as a mobile phone or any other subscription-based model will charge. And we grew the message traffic that we charge, and we charge per message, by over 50% last year. And again, in difficult times, we grew our members from 30 to 33. And in fact, on this year, and last year, obviously very difficult when everybody was in lockdown for a large part of it, we've grown our membership by a further 6 to 39 members. If you look here, you can look at just the market share trend ever since we floated the company back in June 2018, when we were sub 2%, to what I've said now is above 5.5%. And here is the graph, just very, very simply. It's a complicated graph, but it shows the blue line is the horizontal amount of liquidity available at the best bid and offer in all those major indices. So if you look at, say, for example, the CAC 40, the second one there, you will see that that blue line is roughly at 20%. We control 20% of all the CAC 40 stocks, the best bids and offer on the bids and offer in 20% size. So very substantial. And what you can see from that chart is what we call the market share paradox. Our execution, the actual amount of execution that we do, is currently between that sort of 5.5%. So when people ask me, do we think we can grow this company and how far can we grow it? Well, as we're growing the market share of liquidity, the available liquidity, then we can certainly double our market share, if not triple our market share. And the impact of that is huge, because the scalability of our business is there. Let's just look at some of the numbers though. Exchange revenue, the basic subscription charges, grew 46%. Our technologies business grew by 83%. The data, which is a new revenue stream in effect for us, grew 165%. The issuers, which is the listings business, we just took that on, and in total our revenue grew by 67%. If we look at that and we look at our expenses grew by 37%, but that's one-off because of course we took on the acquisition of the Next Exchange and integrated those people and their costs into our operation. EBITDA was above expectations at 1.5 million, and the profit before tax was £500,000, and the profit after tax was £1 million. And we have that million because we got a tax credit for R&D, And obviously we have tax credits from previous losses. I think what is important from an investor point of view is many people look at our sort of operation, and when they're cash burning, they always think one's going to come back to the market and look for more cash. Having achieved profitability, you can see very clearly here, our regulatory capital surplus increased and our net cash over the year increased by more than 100%. We have absolutely no way are we looking in the near or medium term future, unless one was to do an acquisition, which I can safely say we are not at this point in time, are we coming back to the market to raise more cash. If I just briefly go through the divisions that we have, we'll talk about those 3 divisions. The Aquis Exchange, in February, the 4th of February, many of you will remember that there was a spat going on between EU27 and Switzerland. And the Swiss were not given equivalence in the same way as the UK have not been granted equivalence once leaving the EU. And what Switzerland did in retaliation is they brought in an ordinance, a law, which basically said anybody in the EU was not allowed to trade Swiss shares unless they were in Switzerland. But the UK and Switzerland have now got an equivalence agreement. And on the 4th of February, we started to trade Swiss shares again. We've also got a market at close product, which we've seen significant growth in over the year and will continue. Now, this is a product a bit like if you have a Sky subscription and you want to have an additional thing, you're interested in football, you want Chelsea TV, or in racing, you might want racing TV. Here, we have something which directly competes with the closing prices of the national exchanges. And it's on a fixed price. And we think banks can save hundreds of thousands, if not millions of pounds a year on using this product. And we've already started to see growth in that particular product. We look at the subscription model. For those of you who are less familiar with us, we start off with a basic tier of £2,000, which allows you 1,000 messages a day. That's an order, it's a cancellation, it's a correction. And it goes right the way up to a new tier that we introduced in October last year of £80,000. Now, we already have a couple of banks who are in the unlimited tier, and we have that confidence that we were capable of adding a new tier due to the fact that we were growing. And in fact, the banks who trade in the very top tier get a rate that is approximately 10 times cheaper than trading on other venues. So there are significant cost savings for banks to use our model. If we look at technologies, what we did is we've grown the business. We've added new subscriptions, new licenses. We operate on a SaaS model, but we did this proof of concept that I mentioned before with the Singapore exchange. Now, what we did is we worked with Amazon in order to get an exchange grade technology in the cloud. Now, why is that important? Well, it's very important because technologically, it is very hard to transmit data in a fast way during using cloud technology. Now, why that is beneficial, I was shown a fact very recently, which was for 92% of your time, your car sits on the road or on a drive or in your garage. But if you were able to buy your car for 8%, because that is the only time, the times you're actually using it, that would be much better value for you. Now, the great thing about cloud technology is that you pay for when you use it. Most exchanges who operate have to spend at least £1 million. In our case, we spend £1 million on hardware. You spend a very significant amount of money renting a data center, which you operate for 24 hours, 7 days a week. If you can move that into a cloud environment, it radically changes your business. And for new businesses, new platforms that wish to set up, be it in the NFT, the non-fungible tokens, be it in coins, be it in crypto, be it in commodities or whatever, then these businesses, I think, will look at the latest technologies of being able to cheapen their entry by able to use an exchange grade technology in the cloud. And that is exactly what we've done. And I think what we've seen since that, whilst this is still a proof of concept and we've proved that it operates and works, what we have seen is a tremendous interest from customers who for the very first time are calling us rather than people within Aquis actually having to make the outbound calls. So we do think this is a revolutionary piece of technology, which over a period of time is going to transform the way that exchanges operate around the world. Market data is something that is very significant to us. We've harmonized that data. And as you say, data is very valuable. And I loved what Vin was talking about, data and analytics. We use data to actually persuade customers to join because we can show that our market is less toxic and we can prove the value of best execution on Aquis. But we also have data, which is very valuable to the market participants outside of those who are direct members necessarily of Aquis. For example, when you have 23% of all the market liquidity, people want to know about that data, so they will pay us for it. Now, the future, I believe, of data will be the creation of some form of consolidated tape in Europe. And that is very, very important, because if that happens, we will see the price of data, which is extremely expensive. And many of you will know that you have to pay additional fees to your data vendors today, your suppliers of data, directly to the exchanges. National exchanges make something in the region of 1 billion euros a year from data. If a consolidated tape comes in, we believe that that price will be absolutely crushed. More than half will fall. But where is it beneficial to Aquis is that if it operates in the same way as the United States through a consolidated tape authority, the rebate of the cost of providing that data, even if it's half of what it is today, is sent back to the exchanges with the volume. So if we reach 10% market share, we will get 10% of all the data fees that are charged across the industry. That is substantially greater than the 1.5 million we're anticipating from making from data in 2021. Now to the stock exchange, something which I think will be very important for all of you. We bought the NEX exchange, not for the companies that were necessarily there or for the way that it was operated. In truth, NEX, ISDX, Plus, OFX, whatever this business has been called, has not actually succeeded and hasn't been a proven competition to the national market. What we want was the recognized investment exchange license, which gives us the only business outside of the London Stock Exchange which is authorized to list equities. Now, what we are trying to do and what we intend to do is build a NASDAQ in Europe. The UK has a wonderful gold standard market, but if you look at what happened to NASDAQ in the 80s and 90s, it was the home for companies that nobody could quite understand how to value. These businesses now are clearly called fintech. And yes, they had their ups and downs, and we saw the dot-com boom and bust. But also what you get from these was you've got great companies like Facebook, Google, Microsoft. Now we're positioning ourselves because I believe there's a massive paradigm shift. And what we're seeing is those years of the baby boomers, where it was seen to be a privilege to buy equities, where people had pinstripe suits and went off to clubs and suggested ideas or whatever, and they then traded through their broker onto the London Stock Exchange. But there are 3 billion people in the world today who communicate digitally. They shop digitally. They game digitally. They watch movies and listen to music digitally. And the Generation X and the Generation Y are going to need to create wealth, and they will create wealth, be it in new and digital assets, and they will do that digitally. And I think people today talk about that as the new economy. And it is very clear that when you look at companies like eToro and others, the average age of their investors, of their customers is under 30, a material change from what we've seen in the past. So here we are positioning ourselves to be the exchange, not as a competitor to AIM, not as a competitor directly to the standard market, but to be out there to transform an industry and allow the public back into public markets. We believe very clearly that the public should participate in IPOs, and we've created a segment of our market called the Apex segment that allows and forces a company that wishes to issue to use a growth prospectus. The growth prospectus will allow individual investors, qualified investors, and in cases retail investors to participate directly in an IPO alongside the asset managers. We've done a deal with market makers to get the 6 largest market makers in the UK to make a spread no wider than 5% for the retail. And if you have competing capital, you create liquidity. We have banned the short selling of stocks so that retail and wholesale investors who come in looking to buy stock are not actually sabotaged by a less liquid market, watching companies fall in price because somebody has decided to short sell them. That raises the capital cost for a company. It often means their staff leave because their options are underwater, and then the business fails. The investors lose. So we protect companies and investors. And we already have 50 odd companies that actually want to come to our marketplace over the next month to 18 months. We've raised capital for digital asset companies. We've raised capital for e-commerce businesses. There was something in the Sunday Times you'll see about esports businesses. And we have a very large list of companies that we think are very important for retail and asset managers to invest in. It was very clear, and I think Karen mentioned this earlier on, through the survey done by ShareSoc, that the retail investor wants to access all markets and all growth stocks, and they do not find that ability today. I was delighted to see that AJ Bell are now electronically connected to Aquis and will hold all Aquis Stock Exchange stocks, both in SIPs and in ISAs, and you can electronically trade. You can do the same with Jarvis. You will be able to, in the summer, do the same in IG. You will soon be able to do this, hopefully, with Interactive that we're working with. You can do this already with Barclays. And so with a combination of retail access, narrower spreads, capital provision, protection from short selling, we actually think we are growing a market that is unique in Europe and will challenge not just the AIM or the standard markets, but the London Stock Exchange long term as being the NASDAQ of the European market. I will just finish with an optimistic outlook. In fact, we saw an article written last week, which I was very proud of, which is Aquis is firing on all 3 cylinders. I can truly say that we are looking at good growth in our core business of the exchange and the subscriptions. With such a large market share of available liquidity, we think we will continue to grow. If I look at the technologies business and I see what we've done with Amazon, and I look at the pipeline, while it can take 6 months to sometimes over 2 years to get customers on board, that pipeline for me looks incredibly encouraging. And whilst the business, the Aquis Stock Exchange business, we lost £500,000, that's less than the analysts expected. It used to lose between 1.5 to 2 million. We're convinced we can get that into profitability next year. And the monetization of that business is not done through listing fees. It is done ultimately through data and building a stock exchange that has very successful companies so that we can create indices at prices significantly lower than investors have to pay today. The maiden profit provides a platform for growth, and we are not frightened about investing in that growth. And we are anticipating to see that over the next few years. So with that in mind, I would like to open it up to any questions that people might have about our business.
Thank you, Alistair. Let's see what we've got. I think we've got a good few here. When do you see regulatory pressure on the best execution start to impact choice of trading venue?
You know, the sooner that happens, the better. And it's been one of the big disappointments, but the regulators have been very much focused on Brexit and then obviously very much focused on COVID. It is very clear in the regulation that there are 5 things that go into best execution: price, depth of liquidity, speed, cost, and this horrible thing called likelihood of execution. Now, in 4 of those things, Aquis is the leader. The best in depth, 96% of the time at the best price, speed, we're the fastest exchange in the world, and cost, with every single level of the tiers for the subscription, we're the cheapest. And in fact, the marginal cost of 0 makes us substantially cheap. But this likelihood of execution, the market often perceives as market share. Now, the problem with that is if you look at historic market share, it's not accurate about what the current environment. And the example I always give there is, what would you think if you decided on what the weather is today by looking at the last 5 days or 1 month's weather reports? You need to look outside your window and see if it's raining to take an umbrella or it's sunny to take sunglasses. And the problem with a lot of the bank's smart order routers, that in many cases aren't quite as smart as they possibly should be, they look at historic market share and are not looking at accurate liquidity where it is today. And that needs to change. And a lot of that is why I liked Vin, is about proving these points and using a lot of machine learning and artificial data, which we're doing now, in order to prove to both our customers and most importantly our customer's customer that liquidity and their orders should actually be sent to Aquis, because that's where we can save the liquidity, the toxicity that's in our market or not in our market, because we don't allow the proprietary traders, some of you will refer to them as high frequency traders, to aggressively trade in our market. So we all know that prices move against you when you try and trade. They don't in Aquis. And I can show you charts, very happy to send anybody who wants to see them, that we can save the industry, the end client, over £1 billion a year because of the difference, the way that our prices move to other markets. That's 1 week's pension for every private pensioner in the country. And therefore, that's why we believe we will win, because as more and more people start to move and as our market share grows, then the regulators will look at this and say, how can you? I'm not going to mention which bank it is, but one of the top 15 is still not a member of Aquis. We have 23% of the liquidity. If you trade with that bank, how can they tell you you've got best execution?
Very good. And Jeff's asking, for a sub 10 million market cap business looking to maybe have an IPO on AIM or Aquis Exchange, can you discuss the ballpark cost differences, both on IPO and an ongoing basis?
Yeah, I can. We have rather like what I think children, I quite like with my children. I sort of always use the analogies, and stocks and companies are very much like children. They have a primary school stage, a secondary school stage, and a university stage. Great companies start small, they grow and they mature. And what we have wrong today in the United Kingdom is this one-size-fits-all regulation, a lack of proportionality, and a lack of appropriateness of trading mechanisms. We all know that companies that are 10 million trade differently than ones that are 300 million, that actually trade differently than ones that are 3 to 5 billion. And what we've created is a marketplace that has Access, the primary school in effect, Apex, which is the secondary school, and then the main market, which is your university. And we want companies to progress through those stages in the same way that children change their education. And the behaviors are different, and the rules are different, and the proportionality of regulation is different. So for us, because we've templated and made a lot more technology on things like the admissions document, or in the case of, we had one recently with Samarkand, who came into the Apex market, it's an approved prospectus, a growth prospectus, approved by the UK Listings Authority, the FCA. So this is a higher standard than AIM. The cost of doing that is roughly somewhere between 1/2 to 3/4 of what the listing is for the London Stock Exchange or AIM. I know at Aquis, it cost us £1.4 million to float our business. It should be nothing like that. And it took 9 months to do that. We reckon we can bring businesses in on the Access in a matter of 4 to 6 weeks, the cost being roughly half of what you'll pay on AIM. And on the Apex market, as I said, between 50% to 75% of the cost, and it's probably going to take you 3 to 4 months.
Okay. And I can mention Samarkand are going to be coming to present here on Mello in May. So we'll be bringing one of your companies to see us, which is great. David Brunsden asks, congratulations on the maiden profit and the excellent 2020 progress. Of the 3 divisions, which will provide the primary impetus to growth in 2021?
In 2021, it will be the actual original exchange business. And the reason I say that, and that's not because I believe that's where the huge amount of share value will ultimately be created. But for example, and I've said this to a number of investors recently, in fact, a number of times even today, which is if you have 4 customers who sit in your £30,000 tier, and I concentrate and do nothing else but force them up into the £80,000 tier, the all-you-can-eat tier, that's making 50,000 per client, 200,000 pounds per month, 2.4 million. The additional cost of operating the exchange for that is 0. It is 100% of profit for us, straight to the bottom line. And that's the gearing, and that's what we love about this business. So in the 2021, we're really focusing on how do we push the tiers, the customers up through the tiers by looking at data and looking at these arguments, and how do we build more customers? Now, at the same time, that doesn't mean we don't focus on the technology. And ultimately, I think some of the greatest value was if we can create a NASDAQ in Europe, that is enormous value to the shareholders long term, enormous.
And Edward asks, do you have any strategic relationship with Primary Bid, or is the Aquis Exchange locked out from using Primary Bid, given that the LSE have a strategic 9% stake already in Primary Bid?
Well, we had very open conversations with Primary Bid, but they decided to go to bed with the London Stock Exchange, and they have an exclusive arrangement with the London Stock Exchange. So whether we would or would not be allowed to, you know, they simply do not allow us. We actually think we have the better solution, which is if you allow your customers to come in, you, the retail market, in an IPO directly, because the standards are higher and the prospectus has been written, then actually the costs are lower for you because there isn't a third party. And there are many, many brokers who can provide the services to provide the book build service for you to participate. So in fact, the irony of it is, having excluded us, they've actually helped us because we can now go out there and deal directly with qualified or individual investors.
Now, John asks, why is Hargreaves not dealing with Aquis?
Well, I got one message, which is everybody.
Hargreaves Lansdowne, I presume that is.
The answer is they will trade, but you've got to phone them up. There is an irony because I have my account, or I have an account with Hargreaves, and to be honest, I get furious. All I would ask is everybody who's on this call who has an account with Hargreaves, or in that case Interactive, but we think Interactive are very, very close, Halifax, which won't even take our call today, to phone up and say some of the most exciting opportunities for the retail investor. We've had many, many companies up by, 50, 60, 100%, some of them 400%, really good returns, liquid, ability for you to be able to trade in and out. We look at KR1, we look at all the, lots of different companies there, which you're missing out on. And frankly, to have to phone up and pay £50 to trade, over the phone is ridiculous. And a lot of people do write to me directly, and I say the same thing. Please call them up. It's your market. You want access to it. We have exactly the same status. We are a recognized investment exchange. Anybody who turns around to you and says there's less liquidity or there's no HMRC approval, it's just not true. And we can show that. We'll give you the evidence to back that. It's because today they haven't. And I think they're surprised of how quickly we've managed to get momentum, because there's no doubt the industry wants competition in the primary space, and they want liquidity in these growth stocks. And that is exactly what Aquis intends to do.
Yeah. And Julian asks, what happens if you get a substantial takeover bid? For clarification, I do hold and would not want to take over, at least not yet.
It's very hard for me to say, do we become an attractive asset to people? Yeah, I mean, I won't hide the fact we've got technology, which we saw an outage today by Turquoise. We've seen outages from the Euronext, Japan, New Zealand, Australia, NASDAQ, Deutsche Börse, all last year over the last 12 months. We have a phenomenal technology. I think that's very attractive. We have market share and a business model that's very attractive, and we've got a primary market that's very attractive. But let me assure you that I do believe that this business can be substantially bigger than it is now. I have absolutely no intention of myself of selling equity or of actually selling out to somebody else. I'm careful what I say here because there's now hundreds of people on this call. I know I've always believed on tremendous value. I think we've started our journey. We haven't finished a journey. The profitability is the start of what I think we can do with this. And I think we can turn this to a substantial business. I have no intention of selling this business today.
Right. Oh, well, good points on which to end, I guess. There's still quite a few questions there, but we've come to the end of the 30 minutes, and it's been really good again having you on the show, Alice. There's so many people want to know the answer to the new market, shall we say, and it's good that you've managed to answer quite a few of them there. Thank you.
Well, David, it's always a pleasure. I thoroughly enjoy this, and if people want to get in touch with me, please do. They can. I'll always try and answer their questions.
Yeah, we'll send you on the questions that haven't been answered, and we'll see you, I'm sure, and maybe some of the companies like Samarkand on another show. So that's
great. We've got some very, very exciting ones coming up. So watch this space.
Brilliant. Thank you. Great. Well, now we've got another panel session. We've got a poll before that. Big decision for you all to make. If we have a Mello in the physical sense, hopefully in November, how many of you are likely to be coming? How buoyant are you all feeling on the first day of easing of lockdown? And some of you have been out and about. You're all on mute, I think, guys, but right, I'm going to share the poll. Can you see that? Everyone can see what the results are. Oh, 30, well, this is quite close though, but 39% say they would attend an event. Margaret Thatcher's joined us, that's good. And 32% say no, but there's 29% maybes. So 2/3 pretty much are yes and a maybe. So feeling good. How are you feeling, Pete? You're on mute there.
Hello. Yeah, I'm all right. You know, I've had these ongoing health aggravations. I had my second jab today, and I think I had a hot flush earlier, but I'm not sure.
Oh,
I've been excitement.
Gosh, the second jab, was it better or worse than your first one?
Oh, you know, in terms of you don't even notice it going in, you know. And I mean, I feel fine now, you know. So yeah, there's a lot to worry about. And I won't mention the word clot. I didn't say it.
So we don't want you having one of those.
No, definitely not.
I would say that on Twitter, you are almost certainly sort of top of the list of those that everyone worries and wants to know what's happening if Pete says he's not feeling well.
Yeah, well, you know, hopefully, well, that's great to hear, but I'm sort of okay. You know, it's just having some silly issues that the doctors are struggling to solve, and it's all dragging on and being really tedious. I think I've got a good hunch as to what it is, and I was talking to my GP today about it, so hopefully we can make some progress.
Fingers crossed.
I don't mean it's anything serious, actually, which is great, you know.
We've had a great show. It's been a bit earlier than normal, but we had some good guests, and we're going to finish it with a bang as ever. Not a bash exactly this time. Slightly different format for everyone who wasn't here at the very start when I explained what we're going to do. The idea of this session is for each of David, Paul, and Pete to come up with a company that they feel is undervalued, hopefully, because they're going to set a target price that they'd like to see it get to. And if it gets there, there's going to be a pledge, I think maybe from you guys, but definitely from Mello. We will pledge an amount to the charity if it reaches that target. But the difference is the audience are going to ask questions, so you will have to try and satisfy them that your idea is a good one. But on top of that, the audience are going to vote at the very end to decide on which of the charities gets the Mello money. Oh, you've got to be punchy. No, you don't have to. But I think the audience can weigh up what they think's worthy. So, who would like to go first?
I'll start first if you want.
Okay, Pete, and I think your company is. Let me have a look. You're going for song, I think. Hypnosis. What's the full name of it?
It's Hypnosis Songs
Ah.
Fund. I have no idea how you spell it. There's either a Y or an I or whatever there is in it. Just remember SONG. That keeps it nice and
That's
clean.
what we need. Yeah, great.
I mean, this is a bit of an unusual one because I think, I mean, I don't know what the other guys are going to talk about, but a lot of the time on these kind of shows, everyone comes on and talks about exciting growth stocks and all the rest of it, which is great. But what I'm talking about here in song is the most boring thing you can imagine. And I would see it really as an income stock. I mean, I hold it in my income portfolio. I think at around 122, which is around the price today, the forecast dividend yield is 4.2%. I think it's rising to about 4.4 or 4.5 next year is the hope, if everything goes to plan. So I don't see it as a growth stock particularly, but it strikes me as one of those companies that could give a nice little trickle of income over time. But if I'm sort of hoping that I can hold it for like 10 years, and in 10 years' time, it'll be a massive capital increase as well. And it will be a very lazy stock that I've done almost nothing to and haven't had to worry about too much. So anyway, that's sort of how I see it. In terms of a target price, I mean, I'd like to say 140 from 122 as a target price. I won't bother setting a time frame. Basically, whenever it gets to 140, I'll bang 100 quid into the charity that I've suggested, which is the Backup Trust, which is a spinal injuries charity. Now, I don't know, a lot of people watching tonight may not know me, but I am spinally injured. I was paralyzed at chest level from a motorbike accident in 1998, which is just like so long ago. But the Backup Trust does some fantastic work with kids and stuff. You'd be amazed how many kids get spinal injuries, from horse riding and jumping into swimming pools is such a common one, when they jump in and they bang their heads and break their necks. And the Backup Trust does brilliant work for like getting their confidence up and stuff. And they do things like skiing for paraplegic people and quadriplegic people. And it's brilliant charity, and it'd be great if they get the money and whatever. On to song. I mean, something I must say quickly, because I really don't want to forget this, and it's really important. In recent days, a mate sent me a link to a podcast which was called The Money Maze. I've no idea who does it, but it was totally excellent, and it was an interview with Mercuriadis, who is the CEO of Song. Now, as you can imagine, spelling any of this stuff is not easy. And it's an absolutely cracking podcast. And it's interesting, not just because he talks about Song and where he sees it going and his philosophy and whatever, but it also talks about the whole dynamics of the streaming industry and of the music industry. And it comes across the passion that Merck has for music himself, which I think is a real differentiator with this company, because Song is an investment company that basically buys up catalogs of songs, right? So, I mean, I'll never remember them, but for instance, Nile Rodgers from Chic is on the board, and they own the Chic back catalogue. They've got the catalogue of Lindsey Buckingham from Fleetwood Mac. They've got loads. They've got catalogues from loads of songwriters that have recorded with artists like Beyonce and I'm so bad at remembering. But lots of, like, for instance, they got Shakira's catalogue, which is absolutely massive. And it's not just like the sort of older catalogues that they've got, but they've got them right through the years. And when you listen, if you listen to the podcast, it will come across that Merck sees music as not just an asset where you can get a revenue stream from it, but it's the cultural significance of the music and how music is so important to our lives and stuff, and how, you know, when you're a kid and you had your first date or something, you know, you remember a particular song that connects you with that, and that stays with you through your life. And I think there's so much truth in that kind of thinking, and that lots of these songs have real cultural significance. One of the songs they own the rights to is Don't Stop Believing by Journey, which just hit 1 billion streams on podcasts and whatever, on everything. Yeah, 1 billion streams. And that is the first, I think it's the first pre-1998 song or something, pre-2000 song to hit that level of listens. And it's because it's everywhere. You know, it's on The Voice, on telly, it's on adverts. It's just one of those songs that permeates everything. And that's sort of where the value is in a lot of this stuff. And the interesting thing about it is that because of the history of the music industry, a lot of the potential wealth and the income from these individual songs has not really been captured. So I can't remember the exact stats, but something that Merck talks about on the podcast is that in the past, before you had streaming, yeah, in the good old days when you used to go out and buy vinyl and CDs and whatever, right? He was saying that something like 1 in 350 people were the only people who actually paid for music. 349 people didn't pay a cent. They watched music on telly, they listened to music on the radio, you know, they taped it off their mates. You know, there was all these different ways that people were getting music for free. But what is changing now is that music is now becoming like a utility. So it's like you pay a monthly subscription to like Spotify or Apple iPod, whatever you do, and you get this stream of music, but you're actually paying something for it. That's the difference. And he was saying how streaming currently is something like 400 million people use streaming at the moment. By the end of the decade, he reckons that's going to go up to 2 billion. So from some 400 million to 2 billion, I mean, that is immense increase. So, you know, the potential for growth here is absolutely massive. So I think that's, you know, that's a lot of the story. I mean, really, that's sort of the nub of it, really, that you know, Song are buying into really interesting catalogs. They tend to base their value. I mean, there's a big issue around valuation of the catalogs, and a lot of people have sort of commented on the way they value the catalogs. What they're actually doing is because streaming's quite a new thing, there's like this historical gap. So you've got a gap from about year 2000 to say 2018, where streaming was sort of happening via Napster and illegal downloads. So lots of streaming was being done and people weren't paying any money for it. Now, as a result, there's like this big gap in the catalogs as to what the real earning potential is. And what Song do is they take lots of historical data of the money that was made for each individual tune, yeah, in a song catalog, and they work out the valuation based on that historical data. But they also then do projections for the catalog in future, but they're not paying for that future. That future is like a sort of upside that they think they can get, but they just, obviously, you know, there's uncertainty around it. But where it gets interesting is that when Song buy these catalogs, I think Merck is a big differentiator. Merck absolutely adores music. He was, I might be slightly wrong on the details, but I think he was the manager of Iron Maiden. He was involved in the management of Guns N' Roses. I think he's done work with certainly Beyonce, all sorts of musical people that he's been involved with. He's a really good friend with Elton John, and obviously with Nile Rodgers, because Nile Rodgers is on the board of Song. And I think this passion about music is a real differentiator that sets him apart from these other song funds or whatever there is. And so the way they, okay, again, if you listen to that podcast, it is so brilliant. He talks on the podcast about the share that an artist and a songwriter gets. And at the moment, under a record company arrangement, I've got the figures written down, but I won't, but it's something like in every pound, 80 pence goes to the record company. And the record company basically wants to sell records. They want to sell CDs. They want to sell the old-fashioned stuff because they make so much money out of it. They got the marketing, or all the stuff, but they're taking chunks of money all along. The artist is just getting something like, well, there's 19 pence, and then that has to be shared out along various things, and the songwriter gets the biggest cut and whatever. But Merck makes the point that the songwriter and the artist are the most important people in the chain. There wouldn't be a record industry if you didn't have those people. They are absolutely vital. You can do without record company executives, as you know. And so the point that what Merck's doing is he's getting the artists to sell their catalogs, but they're also building in contingency payments if there's more achievement out of the songs, whatever, so which the artists can benefit from. And I think also they're getting attractive prices or whatever because the artist wants to go with Merck. And I think that's a massive differentiator.
We've got a lot of questions coming in here, Pete, so let's tune into these. Somebody's asking about Merck here. Steve Holsworth, in fact, says...
Hi, Steve.
Yeah, hi, Steve.
We all know Steve.
Do you have any concerns about a possible conflict of interest between the company and its investment advisor, given that Merck is the founder of both?
I don't think so. I think, again, it's really worth listening to this podcast because it's explained so well better than I could explain it, I'll tell you. I should have just come on and said, see the podcast, listen to the podcast. What Merck says is that he's different. His song is different to normal investment companies in catalogs because they've got this additional angle that they are trying to get a better deal for the artists. They want that 19 pence or whatever it is that the artist gets to increase. They were saying out of that pound, it's something like 29p goes to a streaming service, to Spotify, Apple, whatever. He thinks that will reduce. He thinks that will come down to 25p over time. But he says the problem is that the record company is basically taking too much.
Yeah.
And I think that, this is the point. He makes this point precisely on the podcast. He says that you shouldn't be seen as just an investment company. They are more an investment company because they're actually helping the artist as well. The advantage for the artist is that the artist is in effect monetizing their future earning stream and their back catalogue. Whereas in the past, they were very dependent on the record company. They needed the record company to package up new CDs and albums, rehash of the old rubbish they did 20 years ago. They relied on this kind of marketing and this kind of promotion to get more business. They relied on tours and whatever. Now all that has changed. And one of the things that Song is actively looking to do is when they buy a catalogue, he gives the example of the Eurythmics, yeah? He says, if you were to speak to a record company or a normal investment company in songs and stuff, they'd say, oh yeah, we got the Eurythmics and we've got Sweet Dreams Are Made of This and we got Here Comes the Rain Again or whatever, yeah? Merck makes the point that there's another 40, 50 superb songs in that catalogue that just haven't been exploited. And he says there is huge potential to get these songs rejuvenated and used in different settings. So, for instance, used in TV adverts and advertising campaigns and stuff, used in video games as the background music for video games, used in film as, you know, placed in films and things like that. And all of this is a revenue stream to Song.
Okay, well, we're going to move on to the next two. So just to clarify, it's Song. It's actually Hypnosis, I think, Song.
Hypnosis.
Yeah, but the ticker is Song, S-O-N-G. The charity is the Backup Trust, and you're setting a target of...
I said 140, and I'll pay the money to charity whenever it happens.
Brilliant, 140. And that sounds like a reasonable target from 122, so that's got to be in hit, maybe.
Like I say, it's more of something to hold for years and years and years and to get that growing income stream.
Yeah.
By the way, the dividend is covered.
Yeah, we don't want too much excitement. We just want the charity.
I don't want excitement. I'm too old for it.
Great. Well, David, you must tell us about yours, because it's not one that I know well. Something to do with selling cars, I guess. Motorpoint.
Yeah. The brief was to choose something that perhaps wasn't too, pardon the pun, racy, but it had a good chance of getting, say, a 25% gain on a 6-month view or so. And I think Motorpoint fits the bill. It's a stock I do hold, and I'm having to display some characteristic patience with it, but I am a believer. If it does do 25%, that'll get it back to its pre-COVID high, almost exactly at about 320. I've chosen it for a couple of reasons. One is because it's a COVID-19 recovery play, and which has lagged. I mean, it's not perhaps not sort of caught up quite as well as some of the other names in that sort of in that category. But also, I think it's a very high quality company, and it's got one of those sort of characteristics that I really like, which is it's a sort of cash generative organic growth story. So it's got a very high return on capital, doesn't need to raise equity. It's got a nice organic rollout story. What does it do? It actually focuses on a really specific segment of the used car market, which is cars less than 3 years old and 15,000 miles or less on the clock. I mean, they call it nearly new. Yeah, I guess it is nearly new, but it's these are decent vehicles, but they've taken a big depreciation hit. So there's a 40% discount to the list price. So it's a very attractive deal, and they sell from 14 branches around the country. 2 of those are very immature; they're recent openings, and they sort of invert the normal car seller model. I mean, you go to a new car showroom and you have very expensive real estate there with marble floors and so on, and all the branding, and not very many cars to see. Whereas Motorpoint, it's pretty rudimentary office space with a huge lot and lots of cars that you can look at, and there's a no haggle model. The price being asked is a price you pay, which I think has appealed to a lot of people as well, and there's a clear value for money proposition. As I say, there's an organic rollout story. They think they can go to north of 20 sites around the country. They've got 14 at the moment, and the market share within their segment. I've got the presentation up here. I mean, their market share within the 0 to 3 year segment is 10% in a region where people are within 30 minutes drive of a branch. If it's within 60 minutes drive of a branch, then that drops to 6.4%. So there's a natural sort of opportunity to infill as they grow. Now, obviously, they've been hit hard by COVID. Revenues for the year to March, which they've just announced in a trading update, was down 29%. The first half wasn't too bad. I mean, they were shut in April during that first lockdown, when the weather was a lot nicer than it's been today. So they were shut in April, but they still made 9.7 million profit in that first half, which is actually up a shade on the previous year, which was a very good performance. Now, unfortunately, the second half of the year, the branches have been shut for 4 out of the 6 months. So they've only broken even in the second half. And clearly, this is where the recovery comes. We can all take our view. My view is no more valid than anybody else's on how the recovery will be. For what it's worth, I think there's enormous pent-up demand, very high personal savings ratios, no foreign holidays, possibly again this year. So why not treat yourself to a nice car instead, sort of thing. The thing they have done last year, and this is very interesting, and actually picking up on something Vin Murria mentioned in relation to Kazoo, they've focused very hard on their online offering. Now they have an auction for cars.com website, which they sold 25,000 units last year, and that's the UK's leader in this segment. As an online auction site, and that sells basically their part exchange cars that aren't suitable for their retail offering. But the mainstream retail offering, they sold 22,000 cars online last year, 3,300 in the month of March just ended. Now, March is traditionally quite a strong month for car sales, so you can't really sort of use that as a run rate for the whole year, but it does translate into 50,000 cars. And this is purely online. They do a click and collect when you're allowed to go to branches, otherwise they'll deliver to your door, like Kazoo. Now, Kazoo has only sold 20,000 cars since it started in 2019. Okay, it's a startup, and obviously it's growing very fast, but it's still sold fewer cars online than Motorpoint did last year. Motorpoint's market cap is 234 million. Actually, they've got 6 million net cash. So EV just under 230 million. And as Vin said, Kazoo's rumored to be valued at 5 billion sterling or $7 billion in this SPAC deal, which, obviously is utter bonkers. But what it does do is I think it shines a light on the online value within Motorpoint. And also bricks and clicks, 67% according to the Motorpoint sort of surveys suggest that buyers want to do a test drive before they buy. And online buyers, on-site buyers, those who do buy through a branch are more profitable. You're more likely to sell them finance, you're more likely to sell them insurance, you're more likely to grab the part exchange deal and get a profit on that. Online, purely online buyers are less likely to buy those ancillary sort of products. And you also need a physical infrastructure, which incidentally Kazoo have, to prepare the cars and have as a delivery structure. So I think there's quite an interesting bricks and clicks sort of hidden value, I think, within Motorpoint, which the problems of COVID and forcing them to really get serious with their online offering is sort of highlighted. But the reason I'd hold it really is, or buy it, is because of that, for the COVID-19 rebound and recovery and the very attractive organic growth model and financial model that they have. Sorry. David, you're muted, sorry.
Sorry about that. Yeah, David, thank you very much for that. And certainly we've got a couple of questions in for you. Paul's asking, given Dieselgate, Brexit, and then COVID slowdown in the new car sales over the recent years, of course, do Motorpoint have a supply limitation on growth, which limits multiple and the ability to scale margin? I assume they're heavily dependent on sourcing from fleet and hire car companies.
Yeah, I know that's a key. I mean, I interviewed a company around results, and that's always a question I ask in terms is supply, because it's a key part of it, and it's quite right in that they do get a lot of supply from fleet operators, hire rental companies. And also the manufacturers, who are sort of surreptitiously looking to shift volume outside the traditional dealer network and not impinge on the retail values. And that obviously ebbs and flows a bit. And it's a fair point that obviously new build has severely diminished, and that will work its way work its way through the system. But I mean, they are, well, I just make 2 points. One is this is an enormous market. I mean, it is a very, very big market. And the other thing is, these guys have been doing it for quite a long time, and they know the way around it. But it is, it's clearly something to look out for, and it has an impact on, on margins inevitably.
Do you know overall, David, what percentage of car sales in that sort of segment that they actually handle?
How big that 0 to 3 market is?
Yeah.
They've got 0.5%. They've got a 0.5%. Oh, hang on a sec. Sorry. They've got a 2.6% share of the market. That was in the half year, and it's 1.5 million vehicles a year.
So plenty to go at. They're not necessarily limited too much. There should be plenty to go at.
No, and as I say, I mean, they're geographically they're covering barely half. In terms of the number of branches, and I guess that might change if they can flex the online physical side going forward. But I mean, it's still an immature business in my view.
Great, thank you. And your charity?
Oh yeah, well, I was going to go for the hospice in my hometown of Rochdale. I do find giving to charity quite tricky because I'm very, very nervous about high admin costs and the amount of the proportion of your pound that goes into generating the next guy's pound in terms of marketing. So I like to look for things where I know the money's going to go directly in there. So I'm a big supporter of the hospice movement, and so it's Spring Hill Hospice in Rochdale.
Brilliant, and I'm sure as a smaller charity they'll really benefit, which is great.
David.
Yeah.
David, sorry, can I just throw in a couple of points about Motorpoint, because I think it's quite an interesting one. Two quick things. One of them is that in the last couple of years, I bought a couple of cars. Yeah. One of the things that really impressed me was every time I did on a search on the interweb or whatever, the first company that always comes up is Motorpoint, big orange stuff. I think this was, within the last couple of years. I haven't looked at it in the last year or so, but back then they were clearly ahead of everybody on the online operation. And I think that's probably still ongoing. You need to check it. The other thing is that David mentioned the buying stuff from manufacturers. I remember reading something about Motorpoints, and they've got good relationships with manufacturers, getting like some bulk discounts on stuff. So for instance, Vauxhall might have a load of Corsas that are coming to the end of the line or whatever, and they're really good at getting those new cars and selling them off. If you go on their consumer website, you can just see it all over. We got loads of Focuses coming in, and they're really good deals on this model, blah, blah, blah.
Yeah. No, I mean, it's the manufacturers have got to be very careful because they've got to look after their franchise dealers and not screw the prices through the official network. So it's almost like having an outlet, an outlet shop,
stuff.
and they have that. So you're trying to protect the brand and your franchise dealers, but equally you've got this problem of shifting all this sort of metal that you've built too much of, and that's that's another of the sourcing points for Motorpoint. Yeah,
and just to clarify again on that one, I think the ticker's MOTR.
MOTR, yeah.
Yeah, and £3.20 is the target. Yeah,
is the target, and closed at 258, I think, today.
Great.
I mean that equate the current price. If they were to recover to March 2019 levels of profitability this year, that would put them on about 13.8 times, something like that.
That sounds reasonable.
13.9 times.
Good. And it's nice to see a target that's sort of where it was before. They've not raised any money, so there's no dilution involved.
No, I mean, as I say, the finances are very strong. I mean, it's sort of tertiary sites where they're just big sort of industrial estate type sites. They do a sale and lease back when they acquire them to release capital. The stock is funded through dedicated funding line. I think it's Lloyd's as a main lender. It's a very sort of capital light model, which gives you the very good returns and allows them to do the organic rollout without having to come back to shareholders.
That's an interesting one. I've never really looked at that one. And I do like companies that haven't had to have dilution, because otherwise it distorts things a bit. I know that's one of the things you don't like, Paul. So
yes, that's right. I mean, particularly you had a deluge of companies refinancing, particularly, well, around about this time last year, wasn't it? April, May, there was a stampede for cash. And you look at a lot of companies now and the share count can be up 20% or more, which means the shares are probably not going to get back to where they were on the charts prior to COVID. So I think that's a point that maybe some people are overlooking.
Yeah. Anyway, you're going to tell us about one as well, Paul. So
yeah, well, thanks very much for those two share ideas, gents. I think your points on Motorpoint, David, are very, very interesting. The disparity with Kazoo valuation. So I'll look at that one again. Thanks for that. And I haven't looked at Hypnosis, Pete. So thank you for flagging that. It looks low PE and high dividend yield on the Stockopedia screen that I've just looked at. So I think that's
it's a boring one, but you know, I think it's a different type of stock, really. It really is one where you just park it away for the dividend. That's how I see it. Listen to that podcast because it's amazing.
What was the podcast called, Pete?
It's called The Money Maze. If you just search on that, it'll come up as like the first one.
Money Maze.
Just over an hour, and it's just really interesting to get Merck's passion about music. It so comes across.
No, it does sound good. No, I like to have a good selection of different shares. I like some of my growth at reasonable price things, and I like to have some value and some income stocks. So yeah, I'm happy to look at everything. So my stock I wanted to talk about today. Hello, everyone. Nice to see you all again. I thought I'd do a quick update on Saga. I should mention this was one of my top 2 picks for 2021 and beyond. I'm a long-term holder. So I'm looking to I've already held it for about a year. I'm looking to hold it for several years more. Ticker is also Saga, SAGA. Obviously, it's the over 50s focused business. Its main business line is actually insurance. So it has a highly profitable cash generative insurance business focusing on motor and home policies. Also a smaller sideline in travel policies, which obviously that's dropped very substantially during lockdown because nobody's traveling, but the motor insurance has done very well during lockdown because of fewer claims, and they've shared some of that bonanza with the clients by actually giving some refunds back to clients, which I think is a great move because it builds loyalty. Now the results came out, I think it was last week, about a week ago, and I should declare this is my second largest personal holding, and I've been buying a lot more on results day last week because the results came out better than I expected, better than market expectations. They were obviously poor because the travel division was shut down for a year. But what's striking about this is that the investment case on this was that the share prices utterly collapsed last year, at the beginning of last year, and prior to that it was in a steep decline prior to that because there were all sorts of operational problems. Private equity ran the business for years and ran it into the ground, really. They just milked it as a cash cow. It did a lot of damage to the brand by poor customer service and so on. So the business has had a lot of problems, but I think it's a fantastic turnaround. And the person, the newish management team have got a very, very clear, very focused strategy, which I think is spot on. It's all about rebuilding that customer trust and customer journey and lifetime value and embracing digital. You know, they're doing all the right things to sort the business out. And it doesn't actually need that much of a sort out. This is the interesting thing. So can I screen share, David? I've never done that. I don't know how to. Do I have to press something? Oh yeah, share screen. That's a giveaway, isn't it? Oh God, what do we have to do here? Saga preliminary results. That looks like the one I wanted to show you. Right. Okay, this is slide 11 of 50 slides from a recent results presentation on the company's website in the usual place under the investor relations section. Now, it took me a good hour and a half, 2 hours to go through all these slides and digest and think about it over the weekend. But it's really worth doing because I think it gives you a flavour for all the things they're doing to sort the business out, and it's all very impressive. But obviously this is a very, very quick pitch. So I thought I'd focus on what matters most. And this is the summary of the profitability of the business. The year end is 31st of January. So this year here is the year that's finished at obviously end of January 2021 and has just been reported. And it gives the divisional breakdown. So you can see these numbers are profit figures. So you can see retail broking on the insurance, very profitable, although down on last year because of the mainly by the reduction in travel insurance policies. So that's fine, because that's a temporary factor. Written to earned adjustment, God knows what that is. I'm not very good on insurance accounts. Now underwriting, again, very profitable there. A lot of that was due to reserves releases on bodily injury claims. Some people say, well, that's a one-off, but on the other hand, I think it does demonstrate that they've been prudent in their reserve policies in previous years. So a profit's a profit, it's just moving it from one year to another. So look at how profitable that insurance division is. Bear in mind, Saga's market cap at the moment is, I think it's only around £500 million or just over. So you've got a very, very profitable insurance business there. Now the travel division obviously was just mothballed, so it was zero or close to zero revenues for this full year. I think it basically shut down in March and didn't reopen. So you've got a humongous loss there on the travel division. The prior year, pre-COVID, the insurance was about the same profitability. Travel, it only made about 20 million. Now, but the key thing about the travel is that when the business normalizes, which we hope it will do, because obviously it's serving the over 50s who've now pretty much all been vaccinated, and they can't go on Saga's cruise ships without proof of vaccination in the future. And the travel business is starting up again in June and July for the UK and Norwegian fjord cruises, because Saga owns 2 brand new cruise ships. So the key point is that the profit from the travel division last year only included, I think, 6 months of one of these brand new cruise ships. So the run rate of the travel division's profits in future, now with 2 brand new cruise ships operating for full years in future, the travel division, well, by my estimates, I'm penciling in about a 60 million a year profit for the travel division. It's also got a tours business, which is quite lucrative as well, on top of the 2 cruise ships. Now, in the most recent guidance, the company again confirmed that the 2 brand new cruise ships, which have been just sitting in Tilbury docks for the last year, are expected to generate 40 million pounds EBITDA per annum each. So that's 80 million EBITDA to add on to the prior travel division's profitability. Now, obviously, you've got to take into account depreciation and finance costs on the loans, because they have, a bit like a car loan, they have, large loans secured on the ships, which Saga owns outright. So what I think you need to do, or what I'm doing anyway, is I'm looking at this table here and I'm saying, okay, let's assume the insurance division might do about the same profitability in future years, because the KPIs for the insurance division have actually turned more positive in the last year. Their renewal rates are good. They've had a very, very successful 3-year fixed price policy for car policies, which has sold over 600,000 policies. So there are a lot of good things going on with insurance, but there is an FCA sort of or hearing, or whatever you call it, which might clip away at those profits a bit. So I'd probably say, well, maybe let's factor in maybe 100 to 120 million a year profit for insurance run rate going forwards. For travel, I think you're going to be looking at, well, as I say, this is a bit finger in the air, but I think 60 million profit run rate once both cruise ships are operating and the tours have resumed. That's on an annualized basis. So I'm ignoring the current year, because this is a year of basically nothing in H1, back to normal, pent-up demand in H2. So let's just look at what it would probably do in future, assuming COVID is broadly under control. That's about a 60 million profit there. Ignore other businesses, because that's too small. Central costs, now quite a lot there. They've indicated they've put in play £20 million cost savings. Now, I don't know which division that falls into, whether it wouldn't be a halving of central costs, I don't suppose. It might be spread over the 3. But basically, underlying PBT, as you can see, in the most terrible year when its travel division was just shut down, it was still profitable. 17.1 million in underlying profit obviously heavily down. But I think the run rate going forward, I've penciled in 155 million profit. I think that's possible, or likely even, when everything's running normally and with the benefit of these 2 new cruise ships. Now that translates, even allowing for dilution from the fundraise last year, that translates into 83 pence per share EPS forecast, which is my personal forecast, so it may be wrong. Put that on a PE of 12 and you get to £9.96 a share, which is double the current share price. Now, I think those assumptions are actually quite prudent. And why on earth would you put it on a PE of 12? How many other companies can you find at the moment on a PE of 12? I'd put it probably on a higher PE. So I think you're looking, on valuation grounds, I think you can look at this share price comfortably doubling from the current level, even though it's already actually tripled from the low point last October, which was just an absolutely irrational low. Whereas I've looked at lots of other travel companies and they seem to already be back up to pre-COVID levels. They seem to have priced in all the upside. Whereas this one, I think, is actually a nice mix of insurance and travel, and it really hasn't priced in what earnings are likely to get back to by a long shot, in my opinion. And I'm taking a kind of 2-year view on this. I'm not saying it should double overnight. And I would say this stock is very spiky. It seems to have really strange, irrational, rapid moves up and down. So I would strongly urge people not to buy into any sort of spike upwards, because a while ago I commented on it and it went up about 30% the next day and then came straight back down again, which is really strange for a 500 million company. But you do have to be a bit careful with it. Sorry, I haven't got much more time, have I? How much more time have I got, David?
1 minute.
Oh God. Okay, debt. Look at these slides online. Basically, you've got everything in there. Last slide. This shows you all the debt. People think Saga's financially distressed. It's not. The finances are sorted out. The corporate bond is cheap and it's not due for expiry until 2024. They're just going to roll it. That's not a problem. The ship loans here, the covenants have been waived and there are no repayments due until June 2022. So they got a whole year's worth of, I think that's right. Or was it March? But anyway, they've got a year's headroom on all of the debt. All the covenants they paid off half the term loan with and they haven't drawn the RCF at all. Plus they got 75 million in cash. So this is comfortably financed now. It's not financially distressed. The opportunity is obviously the resumption of the cruise ships, which is starting in June. I've looked on the website. There are only, of 540 cabins available, there are only 67 still available. They're saying that they're 78% booked for the current financial year for all their cruise things, and they're ahead of pre-COVID levels for next year. The working capital turns positive as well when the cruise ships are due to sail, because people pay the balance of the actual fees. So net debt isn't a problem. I think on a PE basis, the shares could at least double with a 1 or 2 year view. There are no dividends for now, so forget about dividends. It's not an income stock. I think it's actually quite low risk, given what they've done to refinance and to manage all the debt. So I'm really bullish on this. I think it's a terrific opportunity. There are not many things out there at the moment that are reasonably priced. This one is, I think, if you dig into the numbers in detail. So have a look at these slides. They're very, very good. And do your own research, obviously. It's just my opinion. It's not a recommendation. I very much urge everyone to do their own work.
Well, I do like your point, Paul, about the other holiday and leisure linked companies seem to have recovered almost fully and Saga hasn't. So.
Exactly. And I mean, I think a lot of them will have to repair their balance sheets. I mean, airlines, I just can't understand the current valuations, given, some of them. I mean, Jet2 is the pick of the bunch. That's the one I would buy if I was buying any airline. But they've had a lot of dilution, they've done 2 quite big placings. And the share, the valuation's back up to where it was pre-COVID. I don't understand that.
Yeah.
Guys, I noticed when you said about what was different, I checked with CCL, Carnival Cruises, and it seems to be the same story there. It's almost like a thing against cruises, but it probably is a bit unrealistic. And as Paul said, the debt is secured on the ships. Well, the thing is, the debt companies aren't going to call that debt in because they won't be able to get anything for the ships. So they've got to sort of give Saga and give Carnival grace to get on with the job.
Yeah.
Yeah, Carnival looks good actually. I don't hold
It
any
looks
Carnival,
very
but
much the same chart to me.
yeah, and they got tons of cash. You know, Carnival could actually clear a lot of their debt from the cash pile, because also when the cash from people pay up front for cruises, of course. Now the interesting thing with Saga is Saga keeps all that cash, customer cash, in trust accounts. It doesn't use any of it to fund the business. So they've had fantastic customer service, because when COVID happened, Saga actually rang up the customers and offered them a full cash refund.
Yeah.
Most of them didn't take it. They just wanted to rebook, because people are so passionate about cruising. Whereas other holiday companies have really damaged their reputation by holding on to the cash for as much as they can.
Yeah, Mike Newman here is making the point they've also got river cruise boats, not just ocean cruise boats.
Yes, and I'll tell you what,
going on one, Paul.
I've booked one in November.
You have?
I've booked an over 50s silver, whatever it is.
Oh, you only just made that.
Yeah, but it's a week.
You're going to be the young boy on the cruise.
Well, these everybody thinks the over 50s are all clapped out, but they want to party as much as anyone else. So I'm looking forward to it.
You'll help them. Yeah.
Yeah. So no, it's a brand new ship, Spirit of the Rhine, brand new. Look, it looks great, and it's going to lots of interesting destinations and free bar for the whole week. So it should be great.
And I often compare the cruise ship prices, and I find Saga are quite often at the top end, so they must have very devoted customers.
They do. People have incredible loyalty to a particular brand. I don't know why they do it, but I've talked to lots of older people who like cruises, and they say things like, "Oh, we're P&O people."
Yeah.
And our next door neighbours, they're Norwegian line people. People do. They really buy into the brand, and the lifetime value of some of these customers. Of course, the over 50s have got all the money.
Yeah.
Over 20%.
They'll want to get out there now.
Well, over 20% of Saga's customers are millionaires, because of obviously they're property rich. They've got fixed income on defined benefit pensions. This is where the money is. It's with the over 50s.
Yeah.
And I think Saga long term, there's so much that can be done with that brand. And Sir Roger de Haan has come back in, who was the founder's son, and he was CEO himself for 20 years. And I think he's transforming the culture there. And he paid a big premium for his 100 million of. He put in 100 million. Oh, sorry. He put in 100 million of his own money into the turnaround. Most of it at a large premium. So, and he's made a £10 million overdraft facility available to the cruise. That was just buried in the notes on the same terms as the RCF. And that says a lot to me. It 10 million may not be that much, but it's a real sign of commitment, isn't it? If your chairman just says, here's a credit line if you need it, guys. I think. Well,
I do like the way that you're going into major hardship to check out your investments. That is.
Oh, absolutely. Oh, shall I mention the charity thing as well?
You must, yeah. And what target are we going for, Paul?
Well, I've been giving some thought to how we do this, because David and I were bouncing ideas around on the phone on this charity pledge business. And my passion is for this charity called Zane, which does humanitarian relief in Zimbabwe. I've got no connection with Zimbabwe, but I visited the charity and did my due diligence on the ground. I've met all the team, hundreds of the pensioners whose lives they keep alive, basically, who would otherwise starve and not have basic medicines. So I really have a really close personal connection to these people. Hence why I donate personally whenever I can. And also, if I have a good trade that pays off, I bank a few thousand, whatever, I'll ping over some money to a few £100 to Zane on their website. I think that's a nice thing. I'm sure other people do that with your own charities as well. So I'm not virtue signaling here, but what I'd like to do, I like this principle of matching smaller donations to encourage people to maybe give 10 or 15 pounds or whatever. And you've used this idea before, David. So my pledge here is that I'm going to set up a Just Giving page, and I will match small donations up to a total of £1,000, and that's unconditional. So basically, we'll raise, hopefully, if people put in 1,000, I'll put in 1,000 too. So that'll double the money people put in, because I want to give some money to Zane anyway. Then in terms of, now the other thing is, a high net worth friend of mine has offered to add 3,000 on the same basis. Wow. So that means that if we raise 4,000 from other donors, me and my friend will chuck in 4,000 in total. And as I say, that's unconditional on any share price movement. Now, if Saga is currently about £3.90, I don't know what you think about this, David, because I haven't run this past you, but I was going to say, if it hits £5, and we were talking about 6 months, weren't we, by September, I'll add another 2,000 on top of the other stuff to match other people's donations, you know? So put that together and we could raise a total of 12,000, which I think would be brilliant.
Would be brilliant. And it's one of those where I think if you can get some of those, what you call the older people that are millionaires going on the cruise, if you can get them to start thinking about Zane, you'll be well away.
Yeah, good idea.
Yeah. We'll have to get Saga to send out a little piece about Zane.
Yeah, that's not a bad idea, actually. Yeah.
Say, look at what this man's doing.
Yeah, that's a great idea, actually. Yeah, I'll follow that up, Dave.
Yeah. I want this all to go viral. I just think it's great if investors can start picking companies that they believe in and set targets and put money behind it for the charity.
Yeah, well, a lot of us have done very, very well. Everybody has. I mean, the small caps index is up 50%, the entire index in the last 6 months. So everyone's done well. And I'm sure everybody's already donating to charities anyway, you know, so, and that's brilliant. So we just thought we'd try and find a way of kind of linking it into Mello, or you did, David, rather. And I think it's a nice idea. Yeah,
and all this, pledges that back somebody else's donation, it's even better. You know, you're getting lots of matches and be great. Anyway, thanks, guys. I think we've pretty much covered it there. We're going to have a vote, I think, on where the Mello £150 goes. Try not to go crazy for Zane, otherwise it's going to be overweighted. Zane, it'll be. Let's see what they think. The voting's going in now, and we've had 462 on this webinar tonight, so that's great. Oh my gosh, you're too convincing, you are, Paul. Right, I'm going to end it now and share the result. Oh, gosh, 62% want to back you, Paul, with Zane.
I'm honoured, but I would say, Pete, I like the sound of your charity, so I'm going to find their website and put a bit of cash on.
Cheers, Paul. Nice one, mate. Brilliant.
We all share,
by the way.
We share the love on
Mello.
Mello.
Well and stuff.
Yeah.
We share the love on Mello. That's great.
Excellent.
Guys, thanks for that. I hope everyone in the audience will go to our website tomorrow and decide if they want to pledge something for their own idea of a share that they want to hit a target. Let's see if we can get this going viral and raise thousands and thousands for charity. It'd be great if we could. Admittedly, every show comes to an end, but we have got a return tomorrow to see David, Paul and VectorVest at noon. And I'll give an update on the charity pledges then. Go to our website to find them. And thank you guys again. See you at another show. We're going to try and have at least one person come on, one investor come on each show to give us their idea. We will be back to the bash, of course, at the end of the month on the 26th. But it's quite nice having a little tweak to it and having a different type of idea. So well done. Thank you. And there'll be an exit form as ever for all of you to fill in. And good to see you all. Back to easing of lockdown. You can go back to the pub again tomorrow. Have you been there yet, Paul?
Not yet, no. But no. We're
very relaxed and cool here. We don't dash down the pub.
It's on the to-do list.
Yeah, I heard they opened at midnight last night at some places.
Yeah.
Oh, great. Okay. Thank you, everyone. Good night from us.